these kind of Saturday events. So let's get started here. So this is going to dive into some stuff that I think really be helpful to everybody as far as the current market kind of situation. These are two great strategies, the butterfly and long condor. But when we get into extreme uncertainty like we're starting to enter now, these can become your best friend. So let us get started. So again, these two strategies we'll cover here today will kind of lead you to a way to kind of hedge and tighten up your risk, but still give you that potential for some really great profit potential and big rewards. And they're also great for quick hedging kind of strategies you can add to core positions. So we'll cover I'll kind of go through and show you all the different variations of these butterflies and condors to give you an idea of how they work. And so that's what we're going to cover. And before we get started, though, let me give you a little background on myself, kind of my trading journey. I started back in the 80s on the oil side. I was fortunate enough to get in with a company called Coastal Corporation back in the days in Houston. They were a big integrated oil company with refining and production, but their big thing was oil trading and their refining. So they would actually had a couple of programs where they would bring you in and they would actually put you through the program to train you to trade crude and oil products, and it was really fantastic. I was fortunate to get into that, my foot in the door, and got into that program. They start you out. They sent me down to one of their refineries. They have one in Corpus, Texas, and I spent about 3 months down there, and it was fantastic because it just gave you the kind of the fundamental foundation of how the oil works. As far as bringing in the cargoes of oil, putting it through the distillation units, and creating products and things like that. So then eventually went into their shipping group and learned all about the chartered ships and doing all that supply scheduling. So that was really beneficial for the cargo side, and eventually got on the cargo trading desk and ended up out in Singapore for a couple of years trading Asian crudes and oil products. So fantastic experience there. If you ever get a chance to go to Singapore in that area, it is absolutely a beautiful city with some of the best food you'll ever have. And then my journey really took off. I got hired by this company, Transworld Oil, and at that time they were the largest oil trading company in the world. It was Transworld, Mark Rich, and Fibro. They were the three large, just huge as far as everything oil. Spent about 17 years there, 16 years in Bermuda, which was the corporate headquarters. And in 1987 in Bermuda, we started trading options on crude oil. So that was where I got my start on that side of things. And eventually we, stretched out into all the other different commodities and foreign exchange. So really great experience. And if you ever also get a chance to go to Bermuda, check that place out. Beautiful island, great people, just a fabulous place to visit and enjoy. So that being said, let us get rolling here. So the following workshop today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So, after more than 30 years trading options, which I have to pinch myself just thinking about it, I've learned that lasting success really comes from discipline, defined, risk-defined strategies, and not just the flashy trades, not just chasing trades and, going with whatever is in the vogue at that point in time. So in today's fast-moving market, which is really getting AI-driven, where the volatility can spike without warning like we saw last week, controlling risk is really essential. Now, that's why two strategies stand out above the rest for me in this kind of market environment, and that's the option butterfly and what I kind of call the cousin of it, the long condor. So these two strategies are very versatile. They're very, very defined risk, which you're going to see, and they're really built and designed to navigate uncertainty with precision, but also providing you the potential for really, really great profits or return on your capital at risk. So I kind of call them my trading secret weapons. So I pull them out in this market, and this is kind of what we're going to focus on. Now, because they're structured to require only a small amount of your hard-earned capital, that's where that risk really gets controlled. your trading returns can really be explosive. So it's kind of like that lightning in a bottle. You know, you just want to bottle up sometimes these really great trades that you find and do it over and over and over again if you can. So that's what's so exciting about it when you get it right. Now, the huge advantage of these strategies is their unique option frameworks that it's designed to take advantage of both the two major option pricing components, time decay and volatility. Now, they can be used in any type of market environment, which makes them really a favorite trading strategy, you know, when we get into uncertain times or uncertain markets. So it just comes about to just knowing when and then how to use these strategies and the tactics behind them. Now, they can work no matter what the markets are doing. We could be in an uptrend, downtrend, or sideways market. It's going to really help to take the unsettling guesswork out of your trading a lot of times. Will eliminate that stress of having to be perfect on the stock's direction or overall market. Going to help you eliminate the time decay expense that you get exposed to from just encountering long options, which are going to be decaying. So this is a great way to offset that, give you positive data. It can be structured for very low cost, low capital at risk, and this can really offer you those huge returns of 20 to 1 sometimes and higher. So you're going to see some examples today of close to 20 to 1 returns on these types of option strategies. So they're very, very exciting. Now, the butterflies and the condors can also be used for your hedging when you mess things up, and that's going to happen to us all in trading. So they can be used as a really fast, low-cost way to cover your, you know what, pronto when a position starts to move against you. Now, I found no really other strategy that comes close to this. And again, in this market, it's a real game changer. So it's something that you need to really add to your trading portfolio. And I'm glad you're here today. So you're going to see how this can work for you. Now, by constructing a butterfly then or a long condor around a strike that is under pressure from another core trade, such as maybe you had a credit spread on it starting to go against you or a debit spread, it's really the best way I've found to immediately neutralize, but not only neutralize, it's going to lower your risk. So this is one of my clients, she's Pam, she was a member. She said, wish I'd known how to use the hedging defense before I lost so much money on credit spreads. So if you've ever done credit spreads, you're probably going to get, you know, and have an idea what Pam's talking about, because credit spreads a lot of times can be, you know, they're what we call probability trades. You go into them based on the statistics. They're a high winning kind of percentage trade, but they're really small winning trades as far as the percent of a return that you get on the risk that you're putting up. So you can make a lot of, you know, little trades going great for you, but then all of a sudden you get that one that rips your head off and that, you know, you lose most of the money on all the prior credit spreads. So the butterfly defense, which we'll talk about a little bit later, is one of the best ways to neutralize a credit spread that goes against you. Now let's take a look at the structure of a butterfly. So the foundation of a butterfly really is combining two vertical spreads. So here's an example of like a call debit spread. So if you look at this and break it down, you'll see this call debit spread. You've got here, say, a long call, and that's at the 10-10 strike. We'll just kind of outline that. And then you're going to be short a call in this example, in this diagram, against it. So what that does, it's going to reduce your capital you put up for the long call. It's going to offset that by the short call. And that's also going to give you a little bit better, you know, theta. You'll still have a negative theta, but that's going to reduce your risk. But you've capped your upside return. So in this example, you're setting up this debit spread for a total risk of your debit paid of $300. Now, your potential profit, though, can be the difference. It's a $1,000 wide spread, you know, 10-10 long and then the 10-10 short. So remember, every one option contract's equivalent to 100 shares. So a $10 wide spread is $1,000 wide. So in this example, if you had a debit cost of 300, that's your cost, then the difference of 700 is your profit, right? So that gives you a pretty decent little return. You can make basically for $1 put up, you make $2.33. That's 233% return. Now we can adjust this trade. We could do something really cool to it by just adding another vertical spread, which would be a credit spread. So here, add a call credit spread to it. And in this one, then we're going to bring in a credit of $200. So we're going to be short here a call, that 1020 call right there. And then to offset that risk of the upside, in case the market rips to the upside, we're going to be long a call above it at that 1030 strike. All right, so again, $10 wide spread, so $1,000 wide spread. Our risk is going to be the difference between our credit that we receive, which would be our profit. So that's going to potentially give us, we've got $1,000 wide spread, brought in a credit of $200. That's your potential profit, but the risk on that, you're risking $800. All right, so that's the really the downside for credit spreads. Okay, so you're risking $4 to make a dollar. So, but this is the cool thing. So what we can do here is we can adjust that super quick. So if you think about it, you had long that debit spread, we're going to add this credit spread, we put them both together, and now we've created a butterfly. So now in this diagram, you're going to see that we had a risk of, $300 on the debit side. We had a risk there of 300, and then we had a credit brought in of 200 on the credit spread side. So we've reduced our risk down here to the butterfly of just $100. Okay. Now the other thing though is great. So $10 wide spread on each side. That's about what we call a balanced butterfly. But we've maintained a lower risk of 100. But if it was to go out at what we call the top of the tent right here, which would be your maximum profit potential, this has the potential to give you a profit of $900. So with $900 profit on your risk of 100, that's going to be, a percent return of a 900% return. So it's a great strategy, and just think about it. So, if you get in a really, any kind of market environment is great, but when you get in really high uncertainty, volatile markets, these are the kind of strategies that I like to go to really narrow in that risk, but also give us a chance to have a big potential profit. We can also, they're very flexible. We can leg in, we can leg out. We can do adjustments. We can do different variations, which we'll talk about. Now, the other part of this is what I kind of call the cousin, okay? So this is the long condor, not to be confused with an iron condor, totally different animal. So with this one, what we're doing is basically we're widening out the profit zone. So, the butterfly just showed you, you've got that narrow, you've got really, it's kind of like threading a needle to get that max profit. But with this one, this is what we use a lot of these because we can, widen out the profit zone, for the condor. We can do any of the condors or the butterflies using puts or calls, determine, based on the market direction. If we're looking at an upside move, we're going to use a call butterfly or call condor. If we're looking for a downside move, we're going to do it with puts. All right, but with this one, we can widen out that profit zone. The other great thing, this is kind of the go-to hedging strategy because we can quickly implement a hedge on a debit spread or a credit spread with a pretty wide profit zone, and then we can narrow it down later if we want to butterfly. So it gives us a lot of different things and options and flexibility that we can do, and that's why I love options, because we can do these kind of creative adjustments to these spreads. Now, the core concept that make the butterfly and long condor work, let's talk about this a little bit. We've got, when we look at options, there are two, option factors for profit generation when we're using the butterfly and condor. And that comes down to understanding how your option pricing works and the concept of time decay, which is measured by theta. And also the other part of that option pricing component that we want to take advantage of is the implied volatility. So these two have a major effect on the price of, your option trades, and especially butterflies and condors. So let's take a kind of short review, of this concept. Now, theta, what this does, this is one of the Greeks that tells us then how much your option price is going to go down over time. So that's the rate of your time decay of your stock option. And by expiration, theta goes to zero. So you want to be aware of that as a buyer of option to know what's going to happen at the end of your option cycle. It's going to be worthless based on time decay, but we also want to be able to maybe take advantage of that with the different type of option strategies. And these two offer you a great advantage with theta. So here's an example, of how basically a butterfly can work and how the pricing can work, so you can kind of get an idea. Now here's, the old company, XYZ, it's trading this example at $45. And we're looking for just a small move down to 43. Okay, so downside target move to 43. So with the butterfly, what I typically look to do is when I have a target, so $43, and this one is our target, we think the market could go to 43. Well, I'm going to set my butterfly up. The body of the butterfly is going to be then at 43. So in this example, you buy one contract, let's say the March 44 put, and it costs you $2.38. So times, 100, that'd be $238. And then you sell a contract of the March 38 put at $1.67. All right. So then you sell one contract there. Then you sell another contract there of $1.67 of the 43 put. But you also then buy below that the 42 put, and that's going to cost you $1.06. So you've got the butterfly, then put butterfly spread set up like this. Is a very narrowing butterfly of $1 wide. See, 44 less 43, 43 less 40, that dollar is between the spreads. So if you look at your net debit, then it's going to be that debit cost of $2.38, for that 44 put, and then plus the debit cost of the 42 put, less your credit that you received here for selling those two 43 puts there. And so that is going to be times 100 to make it equivalent to an option contract. So you can see your risk then would be $10 per spread. Okay, so that's your total risk on the spread. So that these are debit spreads. So basically your risk is your debit paid. Okay, that's the really great thing about it. And also with a butterfly and the condor, long condors, you're going to have a positive theta, no theta decay, which means that if the market stays flat while you're waiting for the trade to work out, you're not getting nicked by that time decay. You're actually it's benefiting you from the positive theta. So if we look at this, you take the middle strike less the lower strike, less your net credit or net debit here times 100, and that's going to be your maximum profit. So if we look here, if XYZ closed right at that 43 target, which would be the top of the tent, then here's our profit. It's 43 less 42, less our debit cost 10 cents equals 90 cents times 100 to make it an option contract. So here's your profit of 90 bucks on your risk of 10, $90 profit, risk of $10. So you've got a 900% return. So you're basically risking $1 to potentially make $9. So, I'll take that kind of return any day of the week, all the time, day long, day and night. So that's how basically the structure works. So let's take a look at how do you choose the best butterfly and long condor strategy. And it all really depends and comes back to your kind of specific trading goals. So one major goal, in my opinion, for every trader should be to select trades that are going to be based on what's going to provide you the most consistent positive return with low defined risk, and not always shoot for the the big home run greatest returns. So I always tell our my members and clients that when you're trading, and that's the great thing with options, we can lower our risk with options, but what we typically look to do is we're looking at the risk first and then our return on that risk. And so we're looking to just hit singles and doubles, and occasionally though, these option spreads, you're going to catch that big fish, and it's going to, you're going to get the huge, home run return. So you're going to be in the game because you're going to stay in the game because you've lowered your risk on each and every trade by doing these types of strategies and tactics that I'll go over here today. Now, one of the best ways then to achieve this goal of picking the best strategy for you is to be aware of the different than option strategies that are out there and available, and there are a lot of different ones, and then understand how they work. And then you want to go about selecting the ones that's going to be best suited for the market environment that you're trading and your specific trading goals. So one thing about these two spreads is that, you can do these with, the hedge funds can do thousands of these, or we can do it, with our small, contracts or small capital that we have for a trading account. We could do one contract, which costs maybe $200 or $100 versus a hedge fund doing, $1,000, $10,000, $20,000 of these spreads. When I opened up a brokerage option over-the-counter brokerage group back about 15 years ago, it's been quite a while, but I remember one day we did it's for this big hedge fund. I forgot the name. They were out of England, and we did 20,000. We did 20,000 contract butterfly spread set up for this group. So they were doing a butterfly on crude oil. It was pretty cool. And so that just shows you can do it with 20,000, or we'll do it with 1 or 2 contracts or 10, whatever. So it doesn't matter the account size, because they can really lower your risk, but still give you that potential for a big payoff. Now, the other great thing when we look at this, the butterfly, I call it the butterfly family, because there's a big variation the way you can use these spreads. And they all have that component of we're selling time and volatility to take advantage of those 2 option pricing components. So here are the different variations of the butterfly family. So you can do a long call or a put balanced butterfly. We can do a wide wing or narrow wing butterfly. We can do what we call broken wing butterflies using calls or puts. We can do the unbalanced butterfly, which are also called ratio butterflies. We can do a broken wing ratio butterfly. Then we could do an iron butterfly. We can do what I'll show you later, a lotto butterfly, the Batman butterfly, Batman Robin butterfly. And then you've got a whole nother category here, which is super important, the butterfly hedge and defense. So then we can also drop down and do the long condor, broken wing long condor. We can do ratio condors, and we can do the long condor hedge and defense. So as you can see, there's a lot of variations and a lot of stuff that you can utilize if you just know how and when, to use these type of strategies or what condition. Now, before we get too deep in everything, in case you have to jump and take off, I'm going to be doing a really in-depth course on the butterfly and condor starting next weekend. And so if you'd like to grab a seat for that and get a discount entry of 15%, let me give you the link and sign up for this thing today. I'll go over a little bit of the details of it, and then we'll go back through the workshop here. We can talk about a little bit later. If anybody has any questions on it, let me pull up the link for you and make sure everybody has this. So make sure you keep this link here, and it's basically powercycletrading.com. Up here you can see it /special. So put that in. You can let me put it in for you. You can just press the link here, and it'll pop up to the sales page, or you can copy and paste it. So here's what, when you copy and paste or click on the link, it's going to pull up this drop-down payment form for you. So powercycletrading.com /special, and then you'll see this pop up. So we'll go through this here in a minute, but this is basically what we're going to be doing next weekend. We'll start next Saturday, the 21st, and we'll start it at 11 a.m. Eastern to 2 or however long we need. And then we'll follow up Monday with the last part of it, and we'll go from 4 p.m. to 5. And then we'll do a follow-up dedicated Q&A the next day on Tuesday. Now, I've got 2 different kind of packages here, so let me just go through this briefly. So course package 1, there's 2 different options. Option 1 will give you the course, which will be $197, but for today with the discount. And for the discount here, I forgot to give you that. Put in butterfly BF, just the 2 letters BF for small cap 15, and that's going to give you the promo code that'll give you the discount. And so I'll show you how that works here in a second. So today you'll get this for $167, and for this price you're going to get the access to the for the live course, and it will also be recorded and broken down in modules. This course then yours forever, and plus the extras, which I'll show you here in a little bit. So basically 92% off on this course package discount. Now, if you want all the bonuses that I'll show you here in a bit, course package option 2, this will be package 1 option 2, with all the bonuses will be basically 167 plus the 30 just for the extra bonuses. So per day, you'll get this for 197. So this will give you that live recorded workshop, live and recorded, plus all the bonuses. So a big discount there. And then what we have here for you next is, if you want course package 2, which gives you access to my Leap trading alert service. and you're going to get this in package 2, and there's option 1, which basically gives you everything in this option for, you know, just the few extras at a lower price. Or if you want course package 2, the alerts with all the bonuses, then this is what you're going to get. So basically the alerts for 4 months, and then I'm going to give you 5 months to my trading club, and I'll show you what that is in a bit. You can do all that today for the price of $507 if you put in that discount code of BF small cap 15. And then if you want all the bonuses, and you're going to get this, it's basically $507 plus that extra $30 for the additional bonuses. You'll get all 4 of my alerts, all 4 months for my 5 alerts plus 5 months for my trading club. All right, so it's a great deal, and you're going to get a huge value out of this. So put in that link, click on it, or, you know, put it in and click on it, or copy and paste it, and this is what will pull up. And let me just kind of go through this real quick for you, and then come down and put in that promo code for your 15% discount, BF15. And so course package 1, here it outlines what you're going to get. You'll get everything here that you can see. I kind of blow this up. You'll get the access to the live course, plus it'll be recorded and broken down in modules. And so the course value is $1,600. And then, but today you're going to get for $167 if you use that promo code. So you'll get all the course materials, all the handouts that are given out. You'll get a 30-day, 1-month trial membership to my trading club, which I'll show you what that gives you here in a bit. And then we'll do a follow-up Q&A, which will be dedicated the next day, Tuesday. Then I'm going to give you my option trading tutorial as well for a little extra here. So, you know, bonus value over 500 and total course value of this package. This is option 1 is over $2,000. So for today, this one is $167. Come down here, click the buy link right there, and it'll pull this up, and then just go on down here where you see that, have promo code, put in, make sure it's small cap, BF15, click apply. Bingo, you've got it, 167. And then if you want my trading indicators, which you'll see in my charts, everything I'm doing today, you'll see my indicators I use. These are indicators that I developed. You know, I've been using these. I developed these back in 2010. So I've been using these for over 16 years. These are fantastic indicators. If you want to add these to your cart, they're $195. Just click that in there. And these are available for Thinkorswim, TradeStation, Ninja, eSignal, and TradingView if you want to add those. So that is course package 1, option 1. And if you want it with all the bonuses, where you're going to get the additional, my recorded Fibonacci price target mapping course, which these are all my prices on my website, that's $297. And then I'm going to give you my other intermediate option course, really good beginners option, intermediate type course. Start trading options today. That's $197 on my website. And on this one, you're going to get, instead of 30 days, I'm going to give you an extra 30 days. So you're going to get 60 days to my trading club, which I'll show you what that's all about here in a bit. So that's a $194 value, follow-up Q&A, option trading tutorial, and the complete option strategy manifesto. So you're going to get all of these bonuses, and you can see that comes out to over 1,000. So full course value with the package of bonuses is $2,700 over that. So you put that in, you're going to get, it's just $167 plus that additional $30, $197 a day. You get all of that, and it's all yours. You know, you don't have to do anything in the future. Just go into your site, which will have open a code for it. We'll give you that, so you can get into your members area for your good stuff, and you can see everything listed here of what you get down below, and then come down here, 234. But when you put in that promo code of butterfly BF15, and again, if you want to add the indicators, you can see those down here. There's a 5 study set indicator that I use: Thinkorswim, TradeStation, Ninja, eSignal, TradingView. Click apply, and you get the price down to $197. Now, if you want then to add my elite open and close alert service, this is package 2. So, you know, you've been looking for more help and guidance, you kind of in your trading, this is a great package for you. What this will give you is my 5 trading alert services. I've got 5 different alerts that I send out. So you'll get access to every one of those when I send it. And you'll have this for the next 4 months. You can start and stop these when you want, if you take off on vacation or whatever, so you're not going to lose your time. Plus, you're going to get not 4 months, but 5 months to my trading club, and then everything in course package 1, option 1 or 2. All right. So here's just a kind of an overview summary. You can see how this has been performing. My alert services, we've had really good success. Now I've started this service, the first part of it, back in May of 2018. So quite a few years back I've been doing this, and then through Friday, these are, full disclosure, these are unaudited results, just summaries of winners, break even. So we've had 983 trades closed out from these alerts that have been sent out for this time frame. Of those closed, 699 of those were winners, 75 break even, 209 losers. So win break even rate of 79%. That's pretty darn good for over this period of time. Now just kind of break it down a little bit more so you can see what it did last year, 2025. Maintain that 79% win break even rate. We had 151 trades closed out, 101 winners, 19 break even, 31 losers, 79 win break even rate. And so a big part of this is my trade selection that I'm sending to you, but another big part are the option strategies that I send along with these trade recommendations that I send out. All right, so that's what's really, helping this high winning percentage type range, or my trade selections plus the option strategy that I send. So everyone will have a strategy. A lot of my members, though, and clients that take the alert service, they don't, they just do their own thing. So that's cool too. So they just want the trades. But you can see here, we've had a high winning percentage last year. And then just for the year so far started, it hadn't been very long. We've had 17 trades closed out, 12 winners, 2 break even, 3 losers, win break even rate 82%. So that's what you can kind of get an idea about. These are all unaudited, but that's kind of what you'd be looking at. Now, when I send out an alert, basically the service kind of rundown, you'll have access to all 5 of my alerts that I send out, which could be depending on the market. I may send you out a butterfly or a long condor. I may send out a calendar or calendar diagonal, depending on what I think is the best trade selection or strategy or tactic is for that environment, market, the price, rent, everything. I just look at a lot of different things. And then it could be maybe a monthly butterfly pin trade, which we do, which you'll see they're really cool. Or it could be selective earnings trades. So we're in the earnings season, and we just did one, Friday on Roku, which was an explosive move. So we do those selective trades, or it could be what I call breakout reversal type trades. These are either going to be debit spreads or credit spreads. So a lot of different types of trades that you may get an alert to. So you can take them all, or take them not, or just be selective on the ones you want. And then that's what you're going to get. So you'll get these for the next 4 months. So I give you a trading guide for each trade. You'll see that a little bit more later on. I'll show you everything there. I do a video review after the market close of the trade to kind of give you an idea why I was doing it. Trades are listed or archived. Then with this, you're going to get access to my trading club, which will give you access to my live weekly Q&As every week, live and recorded. This will be not 4 months, but 5. That should have been 5. And then I do a video, a daily newsletter. You'll get that each day after the close. Again, that'll be for the next 5 months, and access to my virtual trading room for the next 5 months, and 50% discounts on everything on my website, all my software, courses, etc. So a lot of great value there. You'll get a lot of benefit help, from my, kind of leading you through these markets, which are pretty crazy at the time. And I've been doing this for a long time. So sometimes it really helps to have somebody that's been through a lot of the different battles to kind of guide you through. So that's what you're going to get, plus membership to my Power Cycle Trading Club, and that'll be not 4 months, for 5 months. And so this gives you access to my virtual trading room every Wednesday through Friday. So this will be 9:30 to 10:30 Eastern. You typically go longer if you have questions. We need to go over stuff when the market's going crazy. And then we do a dedicated every live recorded Q&A on Tuesdays. And then you'll get my daily aftermarket video every day after the close, members video, trading vault stuff that you get, traders educational, and discounts of 50% off. All right, so that's just a quick review there, but we'll go through more of this later. So here's what you get then, here's the main thing. So you'll see here, if you do course package 2 with option 1, this gives you, those few extras I showed you earlier. So this will be today $507 if you put that promo code in, 50% off. And these are not available on the website. This is just today. And then if you want it with course package 2, the alert service with option 2 will be all the extras, all the bonuses, and that's just going to be an extra $30. So 537 plus we've got a 2-pay if you want that, and so a really good deal there. So just come down here and on this, click if you want this would be option 1, and this will give you the alert service for the next 4 months plus the trading club for the next 5 months. You can see everything down here below is what you're going to get, and then put in again, it's $597 usually without the promo code. Put in that small cap BF 15. Plus, if you want the indicators, you can add that to it if you'd like, which I highly recommend. 507, you can do that. 2-pay, if you want those indicators, add that to your cart and you're good to go there. Or if you want it with everything, go to course package 2, option 2 right there. And you'll see everything listed that you get here, all the different options and the benefits there. And you'll get this, everything on for the next 4 months, the alerts, and then 5 months for the trading club, which is added to it. Again, just put in that promo code small cap BF15. You can also add the indicators and you're good to go. So I just kind of wanted to run through that for everybody in case you did have to take off. I don't want you to miss this really great opportunity. And if you have any questions later on, we'll go through it in more detail. So that's what you're going to get. And again, this will start next Saturday, the 21st, 11 a.m. to 2 p.m. Eastern, and then we'll follow it part 2, Monday, the 23rd, 4 p.m. to 5 p.m. Eastern. You'll receive one, link to give you to Force Access Live, and that'll be used for both days. Everything will be recorded, and then we'll send it out to you usually on the Wednesday following. It'll be broken down in modules like a chapter of book at 30 minutes or less. So you can go through the different modules that you really want to focus on, plus all the handouts and the detailed PowerPoint of the course will be handed to you. And again, this will be yours forever. So that's kind of what you can look forward to next weekend. Hopefully you'll join. Hey, wow, it's Pam. Yeah, I'm so glad you're here. This is fantastic. This is Pam. She was one that was on the credit spreads one time. Okay, great. That's awesome. Hey, I'm excited. That's really cool. Yeah, so here's one of my old members. She was a member for a long time. Thank you so much for being here. Yeah, make sure you sign up. So everybody, take Pam's advice. And I'm really happy that you're here. So I used to see her every day in the trade room. Here you go. Make sure you use that link here, powercycletrading.com/special, and then use that promo code. Make sure it's small cap BF15, and pick the package you want. Okay, so there's something for everybody here. Just pick the one that's best for you. All right, there we go. Thank you for being here. And Charlotte, bit chilly. No, it's been nice here. We just had some rain today. Now, here's one thing else I want to point out. Sometimes there are other people, members, clients, whatever, that may have taken this course. I typically will do my different courses. I'll go back and maybe once a year or 2 times a year. So this one, you won't see this course coming out again until next year, or maybe in the next 6 months or 6 months later, put it that way. But if you taken a course from me before, you'll have your members area, which will show you all your courses that you can click on and always have access to. So you would just go into your members area and see here, it'll show everything you might have. So you just see if you have the butterfly strategy, and that'll tell you. But if you don't have that, then you've never taken the course before from me. So just be aware of that. Okay, so let's take a review of some of these different trades and different variations to give you an idea of which ones might be most suited for you or how they kind of work. So again, there's a lot of different variations to these types of spreads, which make them very dynamic. So one thing too to point out that we can adjust our risk by using the butterfly by what we call the wingspan. So if you've ever collected butterflies, which I haven't, but this is kind of basically the premise is that if you have, it's going to be easier if you've got a big net, right, to kind of, catch that butterfly versus a tiny little net, right? So we can do kind of the same concept with the butterfly. If we really want to capture a wide range potentially for a potential profit, we can do what we call the wide wing butterfly. But if we really want to get a really tight controlled risk in a crazy market like now, we can narrow the wings of the butterfly and make it narrow. So that's going to narrow the cost of the trade. It's going to reduce the cost of the trade, reducing your risk, but it's also going to reduce your potential profit, dollar profit, but your return on your capital is going to be, really huge because your risk is going to be reduced so low, but you're still going to get a nice potential return of typically on these things, on a narrow wing butterfly, you could get 4 to 1, 5 to 1. On these wide wing butterflies, you can get over 1,000% sometimes or 2,000%. I mean, it is crazy, so what you can do, and I'll show you how crazy it can be with some different trade examples that we're going to go through. So just kind of hang with me here. Hold on one second, I'm reading. Now we are, this is interactive, so if you have questions, please do put them in. I just may take a little time reading them, and sometimes I miss them, so put it back in. Here's a question here, I'm just checking out here. Well, that's great. Appreciate it, David. Here's another, it makes me feel good. It's like your old school teacher. I've been doing this for a long time. So here's another, I guess you would say, student. And I appreciate you being here today. This was David. And let me give this to everybody that he's now a full-time option trader. So he started out, with some of my courses and had my alerts and used them. And there we go. Really, really cool. That's great. So make sure you, sign up and join us. Get a refresher or learn how to do these different variations to add to your trading portfolio. So for $167, how can you go wrong? You'll probably make it back on the first trade. Right. So here's an example of what we're talking about with the narrow wing butterfly. And the other really great thing with these option strategies, we do these, a lot with the ETFs, SPY, QQQ, the Russell, but also with the index options, SPX, NDX, those things. And then you can do it on futures, anything you want, okay, anything. If it moves and it's tradable, you can do butterflies, you can do condors, long condors. But here's an example of one that we had done. And these examples come from trades that we may have done in our trading room or from the alert service. So here's an example of a butterfly that was on SPY, okay? So with this butterfly here, my target, the key thing is we want to target where we think the trade could go to. So what I like to use what I call Fibonacci price target mapping. And so here you can see we had a swing high to low. So we had our Fibonacci levels of 382, 50%, 618. Now, also the 618 is just a huge kind of the ultimate level that the markets can gyrate to and then potentially stall out. And then if they break out, they're typically going to go back to the high. So we had a setup here. Plus, there's a lot of option activity at this strike coming at the 273 strike. So we had a Fibonacci level. We had moving average areas over here, plus option activity. So we set up a butterfly, thinking there's a high chance that we could go to 273, but we wanted to make it very low risk. So here's an example of a super low risk, narrowing butterfly with a target to that 273. So this is then went out. Here's our body of the butterfly is what I usually put to the target. So we did a dollar wide spread. So 272, short the 273, short the 273, long the 274, narrowing butterfly, dollar wide. Max risk, 10 cents. Debit, that's $10 per option contract. The potential profit, spread width of the dollar, which is $100. Less your cost of the trade, 10 is your debit cost. Potential profit, 90 bucks. If it goes out the top of the tent, you nail it perfectly, 900% return. Risk $1 to make 9, I'll take that all day long. So this is one that ended up with like 70 bucks per spread, you know. Okay, but look at this return, that's a 700% return. So you can tell your friends, oh, I just made 1,000% return. They'll probably say you're a liar, but with the butterfly and condors, these are definitely trades that you can get those type of returns. So here's your risk of 10 bucks, potential profit 90, and there you go. Now you're not gonna, you know, we don't look to make the max profit typically on these. We're just looking to, we'll take any part of it, but sometimes you get the home run, you know, you get it to hit. So here's where this went out. You can see the risk profile here. It's going out right here, pretty close to that target 273. So here it was at the day of expiration. Okay, that's when everything kicks in, time gets really crushed out, volatility gets crushed out. And so here it came down, and this was up from 10 cents up to 80 cents or 80 bucks. So we had a profit here of $70 per spread. In this example, on 4 contracts, that's $280. You know, their profit. And if you look at, you know, always analyze everything per contract, per spread to see what it actually did. That's a 700% return. And these are taking advantage of that time decay that accelerates to 0 at expiration, volatility that goes to 0, giving you the potential for those really high returns on your capital at risk. And your capital at risk here, 10 bucks. I mean, that's about as low as you can get. The other one that we typically will do these things wider though, because these give you a bigger dollar profit amount. So here's, you know, the wider wing butterfly. So in this one, yeah, so question here, here's another question. We teach about when you decide on narrow range versus a wide range butter. Absolutely, that's a big part of the course, and that's a great question. So definitely we'll go through, you know, how do you pick and which one to use. So not only for the butterfly wingspan or width, but also for all the different variations. So there's, you know, a lot of them, but we'll cover basically what is kind of the primary go-to, but I'm going to give you the other variations with all trading examples and when and how and why that you would use them in the course. So it's a lot, you know, because there are a lot of variations, but in the course, I'll go through every one of them so you'll have an idea of how they work and then when you would use that specific variation. And then it's yours forever. You can go back and as part of your trading library, and you can go back and think about which one you might want to use in a certain situation. Now, the wide wing is one that we go to a lot because what it does, it gives you that wider profit zone, right? So you get that bigger net of potential profit. But again, it's going to be structured to find risk. Risk is the first thing I look at, and then what is my return on that risk? Do I want to do that? Great for hedging because we can leg in, we can leg out, we can, you know, do so many different things. The other thing that we really always kind of consider is their targeted directional swing trade type trade setups. So when I look at a trade for a breakout up or down, I'm always looking at what do I think the potential target would be for it to go to, either up or down. And I base all that based on the, you know, implied expected move of your option series you're using in what I call my Fibonacci price target mapping, which takes in consideration of support resistance levels based on Fibonacci moving averages, option activity. Okay, so those give me areas of either major resistance that I think markets can go to and maybe stall out at, or major support that it can go to and stall out at, and these become the targets. Okay, so that's what I'm trying to say here. So the directional swing targeted trades. Now swing trading being medium term type trade swings. Okay, So what we're doing primarily is we're looking at swing trades where a swing trade is defined by daily cycle movement. So basically a daily price chart, we're looking for the cycles or the swings. So, we have a move down, we have a move up, we have a move down, we have a move up, whatever. So this could be a descending trend, right? But that trend is not going to go straight down typically. It's going to have cycles. Now, sometimes it can collapse, but then they usually bounce back. But, or an upside move. We can be in an upside channel and we're doing those swings up and down on daily, right? So we're trying to pick the tops, the bottoms of those swings that we call those swing trades. And then we use options and these strategies to trade those swings. Now, the other really, really fun thing are what we call directional pinning trades. And so this is where we're looking for the price at expiration to be at a specific price at expiration. So these are really cool, and these are what we call pinning trades if it pins at a certain strike. Now, again, in this environment we're starting to get into here with volatility increasing, these two strategies really will, like I said, become your best friend. So great for high volatility markets because they reduce your risk, but what else they give you is, now when you have the option pricing is based on time decay and implied volatility. Now, when the markets go down, typically implied volatility goes up. So when implied volatility goes up, we are selling volatility, we're selling time. So we're getting more, a higher price from the implied volatility component. So we're getting more price that we're collecting for the premium. So this makes these trades, cheaper or more profitable because of that volatility component. So that's what you get there. And then the other thing, again, great for also trading high price stocks. So there are a lot of stocks that, you might not be able to trade because they're too expensive for your trading account. I mean, you could have a $500 to $1,000 to $2,000 per share trade, cost per share, and that's kind of prohibits you from trading it. But with the butterfly and condors, we can still trade high price markets, which you're going to see here in a minute. Now, the trade duration on these types of trades are typically, it can be 1 day out to about 2 weeks. Don't like to go too much further out than that. I'll show you why. And they will always give you what we call positive theta, no time decay. All right. So if the market's just kind of going sideways while your trade is trying to, work out, you're not losing on that trade. You're actually gaining a little bit from the positive time component of that theta. Returns on these trades, and especially the butterfly. Now, of all the option spreads, the butterfly will give you the biggest return on your capital at risk of any option spread out there. So typically you're going to get, we look for 2 to 1 to 10 or even higher on these types of spreads. So great positive risk reward versus, you look at a credit spread like that one I showed you earlier, you have a negative risk ratio. You're risking, $4 or $5 to make $1. So you're thinking, why in the hell would I do that? When I can risk $1 and make $2, I can risk $1 and make 10 or 15 or 20. Why would I do that? Waste my time. So here's an example of a wide wing put butterfly, a downside move, and this was structuring this a wide spread, $1,000 wide, to give us a big wingspan. So here's the example here. This is one that we had done. And again, these are my trading indicators. If you want to add these to the cards, these are based on momentum for price direction that I use. I've been using these now, I guess, 18 years. I designed and developed this system back in 2009, 2010. I've been using it ever since. Tweaked it a little bit with just different things. But you can see here, just basically, momentum had gone negative. We had a cycle reversal. Momentum, cycle 1 go negative. We break a key, what I call a price trigger point, and then we, trigger the trade to enter. And then this trade, then we use the option butterfly for the trade when it broke this level here. So it was trading at 314.60 right here. See that orange arrow? So it's trading 314.60. That was right in there. So it started to break this area here, this 21 exponential moving average. That's what I call my price trigger. And we put the trade on. So we were targeting on this trade 304. which was a key area down here. This was right here, 300. This area here, this is the 50 simple moving average and a 50% retracement level right there. So this is an alignment with this area that creates a target, which at this trade was 304. So we were targeting that for the trade to go to, and based on that, that's where we set the body of the butterfly. All right, so here's the trade setup. Okay, target 304, and we did this. You know, the trade was at 314 when the market started trading down, broke that area. We bought the 314 put, sold the 304, sold the 304 again, bought the 294. So we had this put butterfly 314 minus 304, that's $10. $10 here, $10 wide, $1,000 wide spread, right? Cost of the trade, $2.10 or $210. So that's our risk. Total risk, $210. If we get everything wrong, we didn't get out, didn't do adjustments, just sat there frozen like a deer in the headlights, doing nothing, we would lost $210. Now we'll never, ever lose the full amount of capital. Well, sometimes we will. We do what we call our lotto trades, which I'll show you in a bit. But with your typical swing trades, the capital at risk, and this one is 210. We're not going to, we're not going to be there to lose the whole full 210, but that's your max risk. Okay, there are a lot of things we would do before that would happen. So here's your spread, $1,000 wide, less 210. So, and that's the other thing to point out with the alert service. You just sit back, and then I'll send you alerts by text, telling you, okay, you've got $200 here you're thinking about, but you're at work, you're on vacation or whatever. I'm the one that's looking at the charts all day, and when certain areas get hit, I'll send you an alert to do an adjustment. Maybe we're reducing that risk. Maybe we decide to take off a leg, add a leg. Maybe we're taking profits. So that's one great thing. If you decide on course package 2, you're going to get my alert service with me, doing the trading for you. Basically, you're just going to step in there and do it, hopefully, and execute the trade. But I'm going to pick the trade. I'm like your boss. I'll be picking the trade. I'll be doing, picking the trades, and you're going to be doing the execution. That's kind of what it amounts to. So here's your potential profit then. Your spread width less your cost, $790. So on that risk of 210, so that's a 376% return if you get it perfect, right? Now we're not looking to get it perfect. We're just looking at our risk reward, but sometimes we will get it perfect. So we're risking $1 to make $3.76. I love those odds as far as the risk ratio on that. So here it was 314, 304, 790 potential max profit, risk of 210. That's a balanced wide wing butterfly. And then here's where it went out. So you can see this was a nice, you've got a big, huge profit zone here though. See, so we're just looking, if we can just take a slice out of this, we're still getting a real big return. So here it went out, we were looking for the perfect was right there at 304. So it went out right here at 306.17. And this was still a really nice return. You can see this was, the debit went from 210 and it blew out to $782. So we had a return of $572 profit per spread. That's one spread. So 272% return. So, if you did one spread, you made 572. If you did 2, 5, 10, or if you did 10, that's $5,720. So that's a much better return than if you'd done the shares. You would have made 3.6% gain on that. So time decay is in your favor, volatility and collapse in your favor, low defined risk, high return on capital at risk. So just kind of be, thinking in your head, if you did shares versus this, and just kind of do those numbers, you get pretty excited. Now, this is a super fantastic example to show you the benefit of the butterfly and why it's so dynamic, because in this one, we're going to go through trading a really high price stock, but we're going to do it with a butterfly, which lowers that risk dramatically. Plus, you're going to see some other great benefits from the butterfly, how option pricing works. So this is an example back years ago when Amazon was, trading over $1,000, and they did their splits and stuff like that. But we would occasionally trade Amazon though with a butterfly because it was so expensive. We didn't want to, pay out the share cost, right? So here's a really good example of that. So here's trading a high price stock using a butterfly. So on the 29th of August, back when this was, you can see it was 2019 basically. Amazon was trading at $1,782. All right, so it had been down here. This is a 200-day moving average. It had come down here. You can see it's just bouncing off that 200-day, consolidating, building support. So the longer it stays, consolidates at a certain level, that creates what we call consolidated support. And eventually it's either going to break that support down or pop to the upside. But the longer it stays down here, it creates more support, and it typically will go the opposite way. And then what we do at Power Stock Trading, using the indicators, they give us the potential direction based on the momentum. So your cycle 1 and 2 go positive. So now our momentum indicators are triggering the potential for an upside move. This is in what we call a volatility squeeze, where those dots are showing a squeeze, and the potential breakout is going to be then to the upside. Now, the next thing that I look to is, okay, then where can it go? So we were looking at potential upside move, first target to 1830, so 1,830. So think about it. If you bought 100 shares to make this equivalent to doing an option, one option contract, you would have been out of pocket $178,200, or if you did margin 50% of that or whatever, a huge amount of capital, and that's a lot of money to put out. Plus, think of the risk. You're out over 178,000. What if it broke to the downside? You're going to be really, really in a bad pickle. But this is what we did. So with this trade, we did it with a butterfly, and we did the whole trade for $80. So we were basically controlling 100 shares of Amazon, which would be a share price here of 178,000, basically, right? We were controlling 100 shares. Remember, one option contract is equivalent to 100 shares. So we were basically trading with the big boys, 100 shares of Amazon, which would have been costing us 178,000. But using a butterfly, though, we were into this trade with a cost of $80. That's one contract. So you can think about it, that if you wanted to even be bigger, $800, you'd be doing 10 contracts. That'd be 1,000 shares, right? Think about that. So here's your potential profit: $1,000 widespread, 1820. So we bought the 1820 call, targeted the 1830, sold that, sold the 1830, bought the 1840. $10 wide butterfly. Top of the tent here would be our target 1830 if it went out there, which it could, or if it went out in between here, you still have a huge return. You have potential here for $920 profit per spread. That's over 1,000%. So you risk $1 to make $11.50. I would love to do that all day long. All right, so here's the next. So that's one really great benefit. You're trading a high price stock for a fraction of the cost. Now, the other great thing is how the option dynamics of the pricing, the model, option model works for the benefit of the butterfly condor, because it takes advantage of, it's a positive theta type trade. And when at expiration, you get to expiration, what happens? Time goes to zero, worthless, right? There's no more time left in it. So all that time component goes to zero. You had a bunch of, when you first did the trade, there was a bunch, you were paying for time. Now, at the end of the day, at the expiration, there's no more time left. It goes to zero. Also, implied volatility goes to zero. So when you're selling, when you're doing a butterfly or a long condor, a big component of this is a sell side spread component. And those you're selling time and volatility. So you get that advantage, and they both go to zero. So here's the cool thing. So here, this is a really great example. So see all that black area in there? That's still potentially profit. That's all the time that's left in the option price and volatility. Now, this is on the day of expiration. This is on the 6th of September. This is the option expiration day. And see, it's right here. Now, this was in the morning. So in the morning, about 9:30, 10 o'clock, Amazon was trading at $1,836. So it was trading right here. See that little purple? That's where it was in time. There was a huge amount of profit still in there. So this was in the morning, so you could think the afternoon that potentially has a lot of profit left. Now, early in the morning, this 80-cent debit cost, it went to $2.30 or 230 bucks. So the spread cost, the profit at that point in time was $150. Okay, you had a profit in the morning there at 150 bucks at that price of 1836. We were looking for a max target here at that 1830. So it wasn't there, but still we had 250 buck profit. Look at that return. Still a great return. I'll take that all day long. 187%. So that's pretty cool. You make 150 bucks on one contract. You're making 187% return. You're trading a stock that would cost you over $178,000. But here's the really, really big bonus. Look at the next chart. Here is in the afternoon. Now look what happens. See all that area down here that was black? That is gone. And here is just what's left. It's been sucking out, going into expiration, going into the end of the day. Time is starting to really decay, and it's going to be at zero in about 30 minutes or so. And volatility is collapsing to zero as well. So you're sucking all that out. That's going straight in your profit from the selling part of the component of the option trade. So here it was, 80 bucks. Now it's at 695. It blew out there. This is the same day. Now you're up $614 per spread, or 769% return. So 4 times what you were in the morning, just in the same day. In the morning, you were up $189. This was 150% return. In the afternoon, you're up 614, and you're up almost 700%. Now, again, look here, if you did the stock, if you just bought 100 shares of Amazon and it hit your target, whoopee, you made 2.69% return, but think about that risk, all that capital that you had on the line. And on the capital here, what'd you have on the line? 80 bucks. So, I mean, you can, it's pretty easy to sleep at night when you're risking 80 bucks versus, when you're, risking a lot more, it's harder. So here you go. You have the trade with the potential for over 1,000. You'll be happy with 769 or something anywhere in between. So that's the really great thing. Now, these are super fun. These are very selective, very special, but I wanted to point these out because this is something that we also do with butterflies. And this is kind of something that okay, good question. Assignment risk. Yes, there is assignment risk, but don't be worried about it. We've never been assigned, on these trades. So just join us for the course. I'll go through how assignment risk works and, how to avoid it, how not to be worried about it. Okay, there's a whole chapter, whole module in the course on assignment risk. So that's a great question. Thanks for pointing that out. Let me see if there's anything else. Am I typically looking at a 3-month chart? Here's my setup. I typically, on the daily chart, I just put in, as far back as I go. So here's Thinkorswim. I use Thinkorswim platform. So I just have this up. This is Apple. So I don't know, put up whatever, what's something good. We'll just put up the QQQ or something. Yeah, so this is the chart I use, and I use just all the time, as far back as I can go. So this, I'll show you here, time axis, aggregate period, daily, time interval, max available. Okay, so I just go back here. I've got this set for max available. I want to see, so what I'm typically looking at, going way back in charts and looking at support resistance. So that's what I kind of tend to go to. And these are my indicators. If you want these, you can add those to the cart. So you'll get, if you do want my indicators, Thinkorswim, TradeStation, Ninja, Signal, TradingView, you'll get 5 studies. Basically, you'll get cycle 1 momentum, 2 momentum, reversal indicator, and then this has some other studies within it, the volatility squeeze, and what we call support resistance package. So yeah, so that was a good question. That's basically what I look at there. So let's take a look at these lotto trades. Now, this was a really good note, little email that I received from one of my members, Bill, and I've always kept it, and it really makes sense. It means a lot here if you think about it. Bill said that the butterfly strategy is one of my favorites. It's the big winners that are so true that eventually make the difference in any trading account. Now, then he says, with all the so-called low risk option strategies being sold to the public, an account without the potential to hit the big one once in a while, not all the time, you're not going to always hit them, right? That's why we're hitting singles, doubles, but sometimes we hit the big one. So you want something to give you that chance to potentially hit that big one once in a while, but also while not betting on the farm or on the ranch. So he says it's a slow ride up a long hill. So, that's what trading is. If you're doing it right, trading, you're looking at your risk first and then your return on that risk. You're just kind of chipping away. So it's that slow ride, but then boom, you get that one and you're staying in business, right? There's so many people, so many traders that blow up because they don't know how to manage their risk and how to do that. These are two of the best strategies to manage risk anytime, and especially when we get in high uncertainty markets or volatility. So he goes on to say the strategy is also easy as ABC, and that's such a good example because we A, B, C, butterfly, right? So Bill, that was so right on. So I always loved this, what Bill had to say there. So here are a couple. These are alert trades that were sent out to members, and we also set these up in the trading room. So this is the one that we did on GLD, the gold, and this is not a put butterfly. This should have been a call. I don't know why I have a call put, so this needs to be changed. This is a GLD. We did this as a call butterfly targeted penning trade. And again, this was an alert trade that was sent out to our alert members. And you'll see here, when we set this trade up, this was trading at 387.90. Okay, it was trading right here. Okay, we had our positive momentum up. So the direction we were looking for potential upside move. And then the next part of the trade was, okay, where do we think it can go? Look back here. See here, see that big spike up? That typically makes a target. You can see, so 400. So we were looking at 400 as potential target. Plus, I look at some other things that my other part of my secret sauce that I'll teach you in the course. So we were looking at 400 as a potential target. So we set this trade up on the 3rd. Expiration was 2 weeks later on the 19th, and we got pretty darn close to this trade to the upside. So again, so here was the trade that was sent out to the members of the alert service for target 400. So we did the targeted trade. So we did 396, 400, 400, 404. So you can see the spread width was $4 wide. So the spread potential spread width 400 and our cost 25 cents, 25 bucks. That's the max risk. All right. So if everything went wrong, boom, we risk 25. That's why I call these, when I send these out, I call these are binary, kind of lotto trades, because you risk the 25. You're either gonna make it or lose it. And if you do make it, you have potential to make, in this example, 1500% return on your money. So a lot of times that's worth doing every now and then, right? Now you could cut it out and lose half of it. What the heck, 25 bucks? You can, if you do one contract, you definitely afford 25 bucks, but you might decide to do 10, 200, whatever. So here's your potential profit, $375 per spread. If it goes right out there, that would be 1,500% return. But if it goes out anywhere but here, you're still making a huge return on your capital at risk. All right, so here you can see your max profit, 375, right? Your max risk, debit paid, and there you go. Potential to make 1,500. So don't question if somebody says, hey, I just made a 1,500% return in a week. You can do it if you know how. So here's where it was going, and here's where it went out. So we left this trade alone, and boom. On the 19th, now it was trading here, 399.74, pretty close, but not perfect, but still we'll take it. So the spread went from 25 bucks to $331. Okay, here it is. So that's a $306 per spread. If you did one spread, one butterfly, you just made $306. which if you look at that on $25 of risk, you made 1,224% return on that risk. Okay, so that's the really beautiful part of that. And that's for, like Bill said, you occasionally have the big one, right? So you add a few of these every now and then to the portfolio. Now, we'll do these in the room and with the alert service, and we've got actually a couple on now. And then, it's just something to sprinkle in, and they're fun to watch. Currently we have one on GLD for an upside target. We're looking up to, I'll show you in a minute, 475, I believe. We've got that one on for 25 bucks. And then we did another one for ARM. Anyway, we've got two on now, on these trade, the same concept. Now, here's one that we had on SPY. So this was a butterfly for a downside potential move. And so this was one that we did back here on the 6th of March. It was trading at 573.80. Again, here's the ETF. And we were looking for a potential move to 560. So right in this area, there's a lot of potential support here. You can see it right here, 560. This is this blue line. There's a 618 retracement plus that's the 200-day moving average. So we were looking, that was kind of our target area here. And our momentum was negative. It broke a key support. And so we had this downside move. We did it super cheap, low risk trade for that target. So here's the trade. This was super low risk. Okay, so we were targeting 560 based on what I call that Fibonacci price target mapping, which if you do option 2 of any of the packages, you'll get that as a bonus option. So 565, 560, 560, 555. So that's a $5 widespread, 500 bucks. The risk on this trade was $39 per spread. Okay, 39, that's it. So your potential profit's the difference. So if you hit that downside target, max target right there, you would have made $461 on that risk of 39. That's a 1,183% return. 461 potential profit, max loss 39 bucks, and there you go. So anywhere in between, that's still a huge return, right? So these are sprinkled in, and occasionally you'll hit it. And so if you get it right, and so here's where it was, 573. Now here it was on the 10th. It was trading at 560.32, almost to the penny. Look at that, and see this area here. There's hardly any. That's the little bit of profit left right in there. That little black smudge there. So instead of getting a full profit though, we left a little bit in there, but this got $470 per spread. That was a 1,069% return in 4 days. Or if you got it wrong, you lost 35 bucks, or you cut your loss and you lost maybe 15. All right, so those are the cool things about it. Now here's another variation, and I'll teach you this in the course. This is just a quick example. This is what I put together in term the Batman butterfly. This is one that we set up on Apple. Right, sometimes you're going to be kind of confused. You don't know where it's going to go. It could, maybe you think it could go up, or maybe it could go down, but you're not sure. So certain situations, this might be a great tactic strategy to use. So here's the example of one that we had. So this was butterfly on the 10th. Apple's trading at 202.70. And we're looking out to the expiration on the 20th, and so we had two different areas where we thought there was big potentially support here at the 200, or the max kind of resistance was at 210. So there was this bracketed range, but we didn't know if it was going to go up or down. So we had the opportunity here. Hey, let's just do what we call the Batman. So we targeted 200 on the downside. We targeted 210 on the upside. And did the Batman because it looks like Batman, right? You ever used to watch Batman? Probably everybody here has. So here's our target to the downside, that 200 strike right there. Here's our target to the upside, 210. So this trade, we had the upside target. We did a butterfly targeting that cost us 20 bucks. We had a butterfly targeting the downside that cost us 25 bucks. So our total cost on this trade, 45 bucks. That's our risk per butterfly spread. And then we had the potential though, the spread blew out here to 205. So we had the potential to make, on this one, we made 160 bucks. And so if it went out perfect there, you make the max profit. If it went out here, you make the max profit here. But we went out pretty close, and this ended up making $160 per spread, going out right there to the downside, which was a 355% return. So that was the Batman. We'll go through this in more detail, and I'll show you how to select the strikes and the targets more in the course, some of the things that I use for that. Now, here's another one that I'll teach you in the course. Here's just what the risk profile looks like. And this is what I call the Batman and Robin. This is really cool. But this is another variation. If you just understand vertical spreads, which I think I know a lot about, this is something that I've come up with. So with the Batman butterfly, you have a big, I'll show you the difference here. With the Batman butterfly, if you do these, see, you've got this area down here, which is a big area for potential loss. The area between your two spreads. See, this is your zero line here. So you've got a big potential to lose down here, but if it doesn't do anything, it goes out in here, you're going to lose, right? So we can take that with this Batman butterfly, design this strategy to take this potential loss out. And so by doing this strategy, it eliminates that loss. And I call this the Batman and Robin. So you can see your 0 point is here, and you won't lose. If it goes out in this area here, you're still going to make money. If it goes out here, you make your max. If it goes out here, you make money. If it goes out here, you make max. And if it goes here, is your break even to the downside. So really cool strategy. I'll teach you this in the course. You'll have everything covered, and you'll be an expert on butterflies. Now, the next kind of variation that sometimes we'll go to is what we call the broken wing butterfly. So this is useful if you speculate on a stock being stagnant to maybe slightly bullish or bearish, and you're confident that that stock is going to break out, and it's going to do it in a certain direction. So you're really confident on the trade, and it's going to go to a certain area, up or down. But if you do a butterfly spread, the risk is inclined, it's simply a butterfly spread with your risk inclined to one direction. So what this does, basically bottom line, is if you're really comfortable with where something can go up or maybe down, you're really comfortable with the trade, but you want to reduce the risk but still have a really big potential profit from the butterfly, this is one that we can use, the broken wing butterfly. And this is a great one for really reducing your cost on the trade. So we can really fool around and tweak this to really make it a low cost trade, but a really big potential payoff in the right circumstance. Okay, so here's a broken wing butterfly. This is one that we had done on Microsoft. So it was trading at 309.45. And we were looking for an upside target, I believe around 314 or so. So here it was on the 17th. Now it's trading at 313.39. So the trade we got into, we had our cycle reversal. We started watching this. So you could see it had broken out, then it was going sideways. We had positive momentum. So then what we were looking at a potential upside target area about here in that 314, 315 level, based on a lot of different things that we'll look at, and I'll show you what those are in the course. So we were looking for that upside target, but we wanted to keep the trade low as far as the cost. But we were pretty comfortable because of this resistance area up here at 315 that it wasn't going to immediately break out. It was going to. A lot of times you'll gravitate to these major target areas, and then after 1 or 2 days, they'll chip away, and then they'll finally break. So this is one that we set up for that move up, but we wanted to keep our costs low, but still have potential for a really nice return if it hit our target to the upside. But then if it didn't hit our target, we have a lower cost in the trade by doing it with this broken wing butterfly. So here you can see the butterfly was set up for expiration 19th of May, and we were targeting that 315 area. So here's your broken wing. We did the 310, 315 call debit spread side of it here, which was $5 wide, And then the credit spread side, though, was wider. So we did this wider so it would not cost us as much. So we had this kind of setup. So we had a wider zone here. So this reduced our cost over the whole trade. But we still had a potential for a huge profit. So if it went out right here, we'd make $415. If it didn't go out there, and our assumption, trade kind of thesis or bias was that it would go maybe up here, and if it didn't go up there, the market was going to probably move back down. So we wanted to keep our costs low, but if it did get up here, we had a potential to make big profit, but we were still worried more for downside. So our cost was reduced to 85 by doing it this way. So we had 310, 315, 322 and a half broken wing call butterfly on Microsoft for 85 bucks per option spread, okay? And that's what the analytic looks like. And then here's where it went out. So you can see here's that broken wing. We had that spread part of it there and then broke that wing there to make it wider here. And so our cost, hold on a second, there's a question that I missed. Here's a question, hold on a second. No, so question is, do I ever do, okay, so do I ever do traditional out of the money butterflies, but do I do in the money butterflies? No, I don't, because we're doing swing trades. We're looking at directional moves up and down, and there's so many different other option strategies that we can use. So I use a variation of different option strategies versus just maybe a certain in the money butterfly. But I just typically stick to kind of vanilla stuff, and then occasionally we'll do some of these different adjustments and stuff and variations like this. So so the answer is no, that I do not. But come in the room, we can always look at those. If you want to, go through a few, we can definitely do some stuff like that. All right. So here was the broken wing butterfly here. So we had a spread here. It went to 222. You can see we're 85 is our cost. The spread now blew out to 222. So we had a profit per spread, 137 bucks on that risk of 85. $161. And then that's kind of what it looks like. So it's going out here, and if you stay in, sometimes we just get out, sometimes you stay in, but it had potential for much bigger profit. And that's another part of the alert service to get out and tell you when to get out, which helps a lot of times. So that's an example here. Now here's another example of what we call the unbalanced or ratio butterfly. So this is a variation of a regular balanced butterfly, but alters the risk to one direction, increases potential return on that risk. All right, so here's one that we had set up. This was on Tesla on the 12th of May. Tesla was trading at 168.50, and then on the 19th, now it's trading at 180. So with this one, this was what we call the ratio balanced butterfly, and a lot of times these are like kind of think of a credit spread. So this strategy is a variation that you might use if you think the market has potential to go to a certain point, but there's a good probability it won't get there, but you can then get a credit for doing the butterfly at that target price. And then if it doesn't get there, your profit is the credit that you set up. But if it does get there, you get the big payout, but on a credit cost kind of basis. So kind of a unique strategy. We'll cover this in the course in more detail, but pretty cool to use in certain situations. So here's one that we had done with Tesla, and the expected move up was $11. So we did this targeting 180 bucks. So just kind of go through this example. So this was doing the 175 targeting 180. So we did this as what we call a ratio butterfly. So you can see here, you've got your long one call leg here, and then your short three. So typical butterfly, your long one, and you'll be short 2, and then long 1 here. So you're long 1 here, long 1 here, short 2. But in a ratio butterfly, you're long 1 and short 3 up here, and then long 2 down here. So I'll show in the course, show you why that's done, and when you, these are not something you do all the time, certain variations, certain times that you do this. And this kind of market we're trading in now is a good time for these ratio butterflies. So in this example, then you can see that we actually did this trade where we brought in a $10 credit for the trade setup. So there was no risk based on what certain direction. So $10 was a credit. So if this did not work out and it just kind of fizzled out, we'd still make 10 bucks. But if it did hit our target, and the target being 180, we had a potential for a big profit of $510, right? See that? So we had a $5 widespread credit of 10, potentially to make $510 on that trade cost of 10. Now, there's no free lunch. So if you got the trade wrong, you could lose 490. So that's what's important to know when you would use this. And that's what the course will teach you. So you got a credit here of 10 bucks. All right. So if you don't know when to use it, you can get annihilated. All right. So these are cool spreads, but you need to know when and how and why to use this, this variation. So this one worked out perfect. I mean, it went exactly where we wanted to go. And we had, if it did, we still would have made 10 bucks. Now we were thinking the reason we were doing this trade was that we were thinking the trade would have more potential for Tesla to, break back down versus rip to the upside. So that's why it was done. And if we did get it right, we're still going to make 10 bucks. Sometimes, I was looking at some trades this week that I should have done. We would have gotten 40 bucks, 50 bucks credit, and then they just cratered. So it would have been a great trade. But anyway, that's where it was, and that's trading, right? So it went to right there, 180, and so now we had a $10 credit. Now the trade, the spread was up to 483. So we had the 483 plus the credit, 493, huge return on that trade. So that's the beauty there of a ratio butterfly. And then here is the long call condor. So this is a debit spread as well. This is one that we'd set up in the alert service in the trade room on Palantir PLTR. This was a call condor. And again, these are really used, we use these a lot because they give you a wide profit zone, wider than the butterfly. The butterfly, you have to thread that needle. With these, we can widen out that zone, right? But also, this provides us that defined tight risk if we need it. Great for hedging. This is the first go-to hedge setup will be the Condor. Great for use for directional swing trades again with a wider profit zone. Good for trading those higher volatility markets and high price stocks as well. Trade duration 1 to 3 weeks out. Again, no time decay. Positive data returns on these are 2 to 1, maybe up to 4 to 1. Now that's why the butterfly, the butterfly potentially, you saw those couple examples, you can get 18, 19, 20 to 1 sometimes on the butterflies. But these are just great because they give you a wider zone and they have positive data and they're lowering your capital costs. So this was our trade that we did on Palantir. So on the 13th, it was traded at 123. And then on the 16th, it was up to 128. So we did this trade. This was our trade I sent out. My indicators were positive, things with potential up to the upside based on Fibonacci price target mapping, where we're looking at kind of a zone for this trade to go out into. And so that's the perfect condition. You'll learn why and what's the best condition as far as your price range and things like that. There are a number of different things we look at. But here's the one that we did on Palantir. This was a Condor. And so this was, you can see we were long the 125 call, short the 127 call debit spread. And then we had the other side of it was a credit spread, 136, 138 here. So that creates this Condor. We can leg in, we can leg out, we can do it all at once. So, so there's a lot of different things that go into how would you do it on a specific stock in a specific market condition, right? Sometimes we may leg into it, may leg out. Other times we may just want to put it all on at once. It just really depends on the market. And that's what we're going to give you the different variations of the course of, when would you do this trade in the various conditions. So this trade was set up for total risk of 72 bucks right here, $72 debit cost with the potential $2 wide spread on each side, $200, lesser cost of the trade. So potential to make 128 bucks, right? If it goes out in here, nothing to sneeze at, doesn't be 177% return and gives us a positive theta. If it just sits here for a while, doing nothing, we're not losing theta. It's actually in our favor because it's a positive theta trade. And that's what you get there, the benefit. Now this went out right here, pretty much like where we wanted it, right there, okay? So this was trading out 128.88, right inside our spreads right there. So it went from 72 bucks debit to 200 bucks. And that's our profit, the difference, 128, 177% return on that risk of 72. So that's a really nice little return there to chip away with your account at. And then here's a really, really cool one. This is one that we just did last week. This is a good example of what I call opportunistic hedge trade management. Now, there are a lot of different ones to do, but this is one I just selected to give you an example of things that you can do on different adjustments and hedge management. So this is a trade that we did, alert trade that we set up about a week back. And this was a trade that we set up, a long trade on Apple. When we set this trade up, this was alert also set up in the trade room. So if you'd been in the trading room that day, you would have gotten this trade as well. So we set this up trade that initially with a long call calendar diagonal spread. And then we adjusted it into the long call condor. Now we ended up making, we have different profit areas that we'll take profit at, but you'll see the profit area that we had one day last week. This was up 1,225%. Okay, from this adjusted trade using this condor adjustment into. All right, so this is what the alerts, we use a service called Telegram. It's a free service that you'll be able to sign up for, if you do the alerts. And so this was just a week back on the 2nd of February, we had Apple's trading at $263.40. So here's the alert that I sent out to the members of the alert service. It said, new Apple long trading around $263.40, right there. Now, and I give you in my alerts, I'll give you a kind of brief, quick description of why I'm doing the trade, so you kind of get an idea. So this is a daily cycle low retracement reversal off the 150 period simple moving average. Okay, so it's bouncing off a moving average. That looked good like that. With our indicators, it had positive momentum, upside momentum, and another indicator I use, what I call my momentum upside cross. It had that. So a lot of really good positive momentum indicators signaling, go long. And so then I give you the targets. So I said target 1, 265. This is based on my price target mapping. I'll give you some targets that we think it can potentially go to. Target 2, 267. Know your risk. Always know your risk. Taking the trade, whatever I send out. These are, these are setups. So you may take the trade or you may not take the trade, but it's up to you. But know your risk. And so this was initially set up to do what we call a calendar diagonal call spread. So it says, and this is what that means, it says buy one diagonal Apple, and this was the series, buy the 13th February series, and then this will be selling the 6th February series. So you're going to be long right here. The initial trade we sent out and set up was we were long out in the 13th February expiration series, which was Friday, yesterday, the 262.5 call, and then initially sold against it, the 270 call in the expiration series that was last week, which expired. So we adjusted this into the condor, and this is what you'll see. Then on the 3rd, here I send you out alert update for an adjustment. So it's adjustment here, okay? So I just walk you through it. I've had so many members that have done the alert service. They never knew how to trade options. They were learning to trade options with the alerts and paying for their alert service, right? So here it says Apple long trading around 269.95. If you are long the spread, so I don't know if you went long, if you used it or not, whatever, but I'd say if you did the spread, then currently you're up around $216 per spread, and adjust the balance. So if you, whatever balance, you may have taken some profit, whatever, adjust whatever you have on. So this was the adjustment. This was the hedge trading, opportunist hedge trading adjustment manager, whatever you want to call it. So what we did was we bought to close. We bought that 6 February 270 call that was the short strike that was in that earlier expiration series, and then we sold to close the 262 call that we were long that 13th Feb because this thing was moving up. So it was progressing. We call these kind of progression trades. So see here when we started, Apple was trading at 263, and price was progressing, moving up. So we did an adjustment to reduce our costs, lock in some profit, reduce our spread cost, and give us the potential for a bigger upside move and profit. So that's where we came in. We sold to close the initial long that we had at 262.5 because it now is trading almost 270. So we had a big, huge fat profit booked. Okay. So then what we did, then we sold against it. We bought to open. I mean, the same series, the 13th at 265 call. So we moved our long position up, booked big profit, moved our spread up to still be able to take advantage of the upside move. All right, so now we had adjusted. We're now long the 13th at 265 call. We moved the call, long call up there higher because we booked that profit. We're at that 262.5. And we sold against it, though, the same series, the 6-7 Feb, but we sold the 275. So we had a nice calendar, really wide calendar spread, really nice looking trade. Now here's the next thing this is what I'm always looking for. I always tell every member client, when you're trading, especially trading options, think 2 to 3 steps ahead. If you like to play cards or chess, then options are the perfect thing for you because, you know, when you're playing chess, you're always thinking of the next move. If he goes there, I'm going to do this, this, and this. And in options, you're thinking if it goes here, I'm going to do this, this, and this. So on the 5th of February, you can see here, I sent out the alert. It said Apple trading around 276.35. If you are long, I don't know if you're long or not, but 13th at 265 call short that adjusted thing that I sent out 275, I gave you some options because sometimes, you know, I don't know your risk profile. I'll give you the options of what I think are different things that you can do. So I gave everybody this alert. Remember, I said options. Okay, option 1, take profit, close out long trade because you had a big, huge fat profit. Okay, so if you just want to get out of it, go home, go to sleep, take a nap, go play golf, boom, you're done. You made a profit, you're happy, and go on to the next trade. Or currently up at that point was currently up $570 in spread, really great, or 156% return on your capital. Or 2, if you wanted to stay in, adjust balance. So with this option, if you want to stick with it to try to make more, what we did was we bought to close that short strike, the 5-6, the 6 Feb, 275 call, close that out. All right. So we closed that out. I think we took a small loss doing it, or maybe we had a profit because of timing. I can't remember. But this was just last week. We just finished this trade on Wednesday. And then sold to close. We sold to close that 265 call for another big profit because now, look, it was trading at 275. It was up another $10. These are the home runs. You know, occasionally I said, you know, singles, doubles, singles, doubles. This one was a home run. So it went from when we initially got in, it was trading at 263. We did adjustment here, it was trading at 270, and then we did another adjustment here when it was trading at 275. So now we've got the adjustment here, closing out that 6 Feb 275 call that we were short and sold to close 265 call, booked another big profit there, and then bought to open. We want to stick with the trade for more upside. So we bought now, same series, the 13th at 267.5 call. And then the fourth step was sold to open. Now in that same series, the 13th at 280 call. So now we just did an adjustment where now we're long a call debit spread on the trade. Okay. So here we are, and it goes through everything. It says now then adjusted trade. You should be here. Now you should be into the 13 Feb 267.5 call long, short the 13 Feb 280 call short. So now what have we done? We've created a call debit spread, a really wide one, $12.5 wide. Now it even gets better. So now I'm looking at the next thing. What can we do next to improve the trade? I'm always looking to improve the trade, and that means reducing your capital at risk and also, reducing and giving yourself better theta. So then we did one more adjustment that day. I was looking to do this into maybe a butterfly or condor to make it even better. So here it was later in the day, and at this, just not much later, this was at 8:54, 8:55, and then about an hour later, we did the final part of the adjustment. So now that it was trading still at 275, so what I sent out was, okay, let's do this adjustment. I said, adjust it. So you're long, we're going to be long at 13 Feb 267.5 call, short the 280. That's where we came in. Now we did one more adjustment. We're going to adjust this to a long call condor. Okay. So by doing this part of the adjustment, we sold a vertical credit spread. We sold a 13 Feb 287 300 credit spread and added that leg to it. And now we had an adjusted long call condor, really $12.5 wide on each side. We had a huge zone in here for profit. So if it kept going up, we weren't going to get, through our credit spread side here, we had this huge range here. So this had a potential to make over, let's see, $800 here. So here it was. So here was the trade, the initial chart setup, just kind of go through it. We had this is why I took the trade. I'll step you through it. First, I had what we call cycle reversal. This is my step one I look at. Step two, and if you want to learn my directional indicators, now I use them. I've got another course, directional trading course on the site that you can get with your discount. If you do the course here today, you can get 50% off. You can go get this course, fantastic, show you how to use my indicators. So here we had cycle 1, 2 positive. We had directional momentum trigger to the upside. And then we had our price trigger was right here. It's trading at 263.40. We're breaking some key areas here. So triggered and went long, and then did this initially with this called calendar diagonal, because with that spread strategy, that's designed for a trade. Maybe a market goes sideways and then breaks out. We didn't know this was beautiful because Apple really had a nice breakout, but it could have just gone sideways. And that's why the calendar diagonal is a great strategy we start with a lot of times. But then it got here, we did the adjustment. Okay, got here, we did another adjustment. That's where we ended up adjusting it to the call condor. No, actually, let me take this back. So we had the initial trade here, and then it got here, and then we did the adjustment to the, we did the one adjustment here, and then here, yeah, that's where we adjusted it to final adjustment to the actual call condor. And then it just kind of jumped around, went sideways, which is perfect for this kind of spread because it's going sideways. We have positive data, we're not losing data. And then we had that spike there. We had a huge profit. We took some profit on that and got out. And then the next day it collapsed. But this was the max profit right here. So this is just kind of outlining the trade. So it started at 263.40, did the adjustment on the 3rd and the 5th, right here, 3rd and the 5th, that's it. And then the profit, max profit on 11th was with this adjusted to the long condor was trading right about $279. Okay, so we this was a really beautiful trade. So here's where it ended up. So the first part of this progression on this trade from the alert was we did this called calendar diagonal. Okay, here's what that looked like. This was being long. That 262.5 call it in the 13th Feb series. This is our long trade duration cycle series, we call that. And then short closer in, that's how calendar works. And that cost us $247 per spread. All right, so that was our total capital at risk. Now, the spread then on this day, the 3rd, was at 270.54. So just this part of the trade was up. The spread blew to 658. We were in at 427. So we had a profit of $231 on the spread, 54% return. Not bad, but we're always looking for better, right? So now here it was again on the 3rd. Now it's trading at 269. 63. So with this, we had adjusted it. Now we had that adjustment done where we had moved up the long part of the trade from 262.5 to 265. We moved the short strike up on that 6 Feb to 275. So we did that adjustment. Now we had $10 wide spread, reduced our costs here to 364 because of the spread, time decay, and all that. Took some profit on the short strike. Now the spread had blown here to 650. So with our adjusted calendar here, now we were up $286 or 79% return. So we're looking at this. We've got a delta of 47. So this is telling us directionally that every dollar goes up, we're making 47. But here, look at this, we've got positive theta. So, if this thing goes sideways every day, we're making $9. Now here it is profit 286 on that specific time frame here. But this, the next move, like a chess move, was to ultimately win by either converting it to a butterfly or a condor, and we were able to convert this to a nice condor, reducing our cost to $75. Because of all the profit we took from the moves up, we had the 262.5, sold to close, bought to open another one here, sold to close that one, bought another one here. So now we end up everything in that 13 Feb series, and now we've got that condor like that, right? And we've reduced, by taking that profit on those adjustments, we've reduced our debit cost down to $75. Sometimes we'll get it reduced down to 0 or even a credit. So now here's what we've got. We've got that, and our cost is $75. So look at the potential. We've got a $12.50 wide spread, both sides, with the potential, if it goes out here, less our cost, to make $1,175 on that risk of 75, a 1,566% return. Okay, so these are definitely possible trades. This is one that we just did. And so here it was, this was just, this was on Wednesday. All right, so now we went from, progressed from 263, whatever it was, to the adjusted price on the 5th of 275, and now on the 11th, which was Wednesday, it was traded to almost 279, and look where we are. I sent out an alert, I sent out an update to everybody that had the trade. Boom, this thing was up, trading at $994. That spread blew out to, so you're up $919 per spread. That's a 1,225% return. So that's what you can potentially have from time to time. So again, if you'd really like to master these high reward, low risk option strategies that can work in any market environment, but are really the go-to ones for this kind of market environment, here's exactly what you can do now. So I gave you everything earlier. We'll go back through all this stuff and take any questions, but I hope that you'll take advantage of this. I think this will really benefit your trading portfolio by understanding and using these. And then in the course, you'll then see every variation, when to use it. You'll see the ones I prefer, and then you can decide on your own, what's the best for you. And then if you want to add the alert service to it, then you're going to get, I'll hold your hand through all the different trades, and then you can come in the trade room and ask questions on the trade and learn more. So it's just a great way for you to learn and learn and learn. And one of the best ways to learn anything is just by seeing, how it works, right? If you twiddle around or on cars or whatever, you like to understand, how does the engine work? Well, the same thing with trading. Look at your past trades, see the winners, how they perform, why they won, or look at the losers and see why they lost. And that's basically what I've done all my career. So, but you'll get my experience, and so hopefully you'll not make the same mistakes I've made over my long career. Okay, so this will be next Saturday, 21st, 11 to 2 Eastern, and then everything live recorded. And then we'll finish up part 2 on Monday, the 23rd, 4 to 5 p.m. Eastern, however long it takes. I'll go until we go through the questions, so I'll take the time that we need. So for today, everybody, if you do course package 1, option 1, $167. Now here's another thing that just was really stood out to me. This is one of my members, Richard. He said, Larry, and this is so true about these types of spreads, said, you are the only one that I know that provides competent, realistic instruction on how to have, he called it Houdini escape hatch. And that's what these types of trades, if you understand the verticals and you know then when to use and do the adjustments, it's kind of like Houdini. That's what Richard was saying. He said, Houdini escape plan to utilize when various types of option trades go against you. And that's going to always happen, right? So it allows you as a trader to calmly use your head to make appropriate trade adjustments instead of, excuse me, panicking and having your head handed to you. So I greatly appreciate you sharing your hard-earned profitable trading knowledge and techniques, Richard. So that's what you'll get here in the course, and that's what you'll get, if you follow along with me, either in our trade room or through the alert service, etc. Sorry, I had to clear my throat. Let me make sure. Here's another, hold on. Question, how do you do butterflies on futures? Same way. You trade options on futures, you just use the options to, you just do exactly the same that you're doing on futures. If that makes sense. Okay, you can, we used to say if it moves and it has a price, if the price moves and you can trade it, you can, if there's a liquidity, which futures have, then you just do the same technique. If you've got a target that you think the futures can go to, instead of doing it on a stock or ETF, you're just doing it on the future. Whatever the underlying is, it doesn't matter. Just, you can call everything the same, XYZ. It's just, it's the same strategies. It's just knowing when to use them and then how to use them. But that's a good question. So absolutely. So here's course package 1, option 1. So this is, if you've got some of my bonuses, or if you don't want them, etc., you just want the raw course, whatever. It's going to be $167 for you today. Now, but also I'm going to still give you though a 30-day trial membership to my trading club. So if you do that, you're going to get access to my trading room for the next 30 days. You can come in and ask questions. You're also the Q&As, my daily market updates, all that stuff. We'll go through that in a second. That's $97. And then if you want to stay on, then it's $97 a month. Or we have other options that you can do, other different programs. Okay, so you get access to that. Then we'll have the follow-up Q&A. You've got access to that. I'm going to also give you my option trading tutorial, which is a really nice option tutorial on the Greeks. So you'll get that. You'll have the live and recorded coding, trading manual, any handouts that are sent out. You'll have all that. Good value there. Course value there. $167. So put that in. Power Cycle Trading /special. Click on that link. Put in BF small cap 15, and you'll get that 167. Add the indicators to the cart if you want for 195. That'll be a great deal. Now, in course package 1, option 2, here's your another option, like the options, right? You're going to get, instead of 30-day trial membership, you'll have the next 60 days to the trading club. Now you can start your time in the trading club when you want. You can start after the course, or whenever you can start it. All right, with this you get the the course, but this will cost you just $30 more. Okay, so with $30 more, you'll get another 30 days to my trading club. This will cost you $197. Okay, but with this, you're going to get another 30 days here. You're going to get my price target mapping. This is what I use to map out all my targets, upside, downside. 3-hour course on that. It's a great course. Highly recommend that you take it, use it. You're going to also then get that Start Trading Options course. It's a really good one to have in your libraries. These are good cost on my website, powercycletrading.com. 60 days to my trading club membership, follow-up Q&A, my option trading tutorial, plus you're going to get my option strategy guide. There's 15 other option strategies, their diagram, when to use them, and what they look like, how they're constructed. So 97 value there. So total value on this package, 2,700, over 2,700, and just for an extra $30, boom. Why don't you 30 bucks, you've got that. It's yours forever, all the stuff that you get. And then if you do want the alert service added to it, that's course package 2. And that's where you get my alerts and you get my 40 years of trading experience guidance in this trade alert package. And so you're going to get my 5 trading alerts. I send out 5 different types of alerts, either butterfly or long condors, calendar or calendar diagonals, or it could be a monthly butterfly pinning trade or calendar pinning trade. Sometimes we use calendars. Breakout reversal trades, which will use debit spreads or credit spreads, or earning options. This week we did a breakout reversal. We did a put debit spread. So we did that trade this week, and I'll show you, we're still in it, which was sent out to members. So there's a lot of different ones just based on the different markets. So with the market crater, and this was a momentum short. So I used a put debit spread for this, and so you might get that. So I sent out that on Thursday. And so then we've got, 4 months the alerts, 5 months for the trading club. And then options 1 or 2 is basically, if you do option 1, you just get, the alerts plus the couple extras that I showed you earlier, or option 2, you get everything. That's basically how it works. And you just put in that BF15 and that's what you get. So here's a better outline of everything. So you get 4 months to the alerts. I don't know, that should be 5 months there. And so you get the course option 1, package 2 will be $597, but today with your promo code BF15, it's $507. There's a 2-pay if you'd like that. And then just for that extra $30 today, if you want everything, it's $537. So it's a great deal there. Wow, thank you so much there for that. Here, I got a note, man. This is a nice group here. I'm so happy you guys are satisfied. Here's another really nice comment. Thank you so much. This is the another benefit of teaching. So I've been doing this now for 17 years. Golly, man, it's hard to believe. So thank you so much. Appreciate that. All right, so that's what you're going to get. Now, again, the alerts could be a calendar diagonal, butterfly or the condors, pinning trade using butterflies or calendars. Could be a breakout, which would be a debit spread or credit spread. Like I said, I'll show you that one in a second. We did a debit spread here Thursday on QQQ for boom. Or it could be a selective earnings trade. We did Roku on Thursday. I'll show you one we did a week back on deck. And then, I give you a trading guide. Like I said, a lot of the members should just give me the trade. I'll do my own thing. But when I send it out, I'll always give you the option strategy that I would use. And then, the details there. I do a trade setup video review after the market close on it. Trades are archived, like I said, and then you get the trading Q&A. We'll do that live recorded every week. You'll get that for the next 5 months. Video newsletter, daily aftermarket newsletter. So I go every day after the close, I'll send out a video newsletter on the market when I see what we're doing, my perspective. You get the access to our virtual trading room during the week, Wednesday through Friday for the next 5 months. That's live, and then discounts on anything on my website. If you go to Power Cycle Trading, I've got tons of courses, seasonality, oil courses, and then all my trading indicators. So I've got a lot of stuff that is accumulated over these many years that I've been doing this. I'll just go check out my site here. I'll give it to you here real quick. PowerCycleTrading.com. And you can enjoy 15% off, but if you do the course here today, it's even better. So you can go through here, look, here are the courses. You've got courses and boot camps. So just come over here at courses, you'll see courses or boot camps. So you go here, you'll see all the trading courses. And then anything here, use your members code, you'll get 50% off. So got, trading cycles and breakouts using weekly options, futures. You got, got selling, option selling tactics for profits, etc. Calendar diagrams. Just completed this course. Earnings season course just did this one. Just all that stuff. Like if you want to do the calendar course or something, you go in there, you see all the details. Come down here, the course price is $397. You put in your promo code, it's 50% off, right? Or if you want my indicators, if you don't sign up today and you want to go back, come here. Here's all my trading software, my scanner that I designed. You can get my custom indicators, my multi-time frame swing, squeeze, breakout, momentum flow, just all this stuff, just a lot. It's a lot that I've done over the years, so it's all there for you if you want it. So that's what you're going to get there. Now let's go through. I'll give you some great examples here of the different variations of alerts that we've done recently here. So just a quick review one more time. So, starting the first part of the alerts back in May of 2018, 983 trades closed out through yesterday, 699 winners, 75 break even, 209 losers. Win break even rate, 79%. Nice, that's a huge rate. Unaudited, and then you can see for 2025, 151 of those trades for 2025 closed out, 101 winners, 19 break even, 31 losers, 79%. Again, all these are unaudited, just summary results. And here we are through just yesterday, 17 trades so far for the year. And these have been a variation. These are earnings trades we've done, calendars, butterflies, just a lot of different stuff. And I'll show you those in a minute. 12 winners, 2 break even, 3 losers. Nice. Hope I can maintain that. 82, that'd be awesome. And again, here's what you get. Here's that link one more time. I want everybody to be here next week with me. And to learn this, if you want to seriously be trading the markets, these are 2 strategies that you need to add to your portfolio. And then, for $167, I don't know why you wouldn't do it. So here's Butterfly 15, BF15, bingo. All right, so join me next Saturday. So you've got all that stuff, right? 167 if you do course package 1, option 1, it's going to be 197, but today's 167, 92% off. You get those extras that I showed you, or package 1, option 2, course plus all of the bonuses, just for an extra 30 bucks, 197 bucks today. And if you want my alerts, which I highly recommend you would do, that's package 2. Option 1 is just those extras that you saw here, option 1 there. So 597 today, 507. There's 2 pay if you want it. Alerts next 4 months, 5 months of the trading club. If you want all of the bonuses and everything, it's just an extra 30 bucks today. All right, so let's go through here what you're going to get in the course. So this is kind of an outline of the course. Here is part 1. I always like to start out with the Greeks so you understand, how these option pricing and the effects of the Greeks have on these spreads. So we'll go through that. We'll go through more detail, theta decay, its impact and volatility, and the importance of that, for pricing your option, how that works. There's a chapter here in the course, or module in the course, where we'll go through using my Fibonacci price target mapping and standard deviation for projecting and selecting your probability directions and price targets. Okay, so we'll go through a little bit of this in the course, but you're going to get that full Fibonacci course if you do, option 2. All right, so we'll go through that. And then part 2, then we get into the variations. I'm going to go through every different variation. And so that's what really, and what makes them work. So we're going to go then how, why would you use it, when. The big part is when would you use it, okay? Really important. When, why, and then how, okay? The easy part is constructing it, but it's really to know when and why. All right, so that's what you get there. And then we go, so go through each variation. So we're going to go through long call and put butterflies. Okay, standard vanilla, but then these are the best. Then we're going to go through the wide wing, widening out that spread, broken wing, ratio butterfly, broken wing ratio, iron butterfly, lotto butterfly, vacation butterfly, and the long condor. So going to cover every variation here with, with real examples, and then, how, why, when would you use those with an interactive course, so you can ask questions as we go. Plus, you're going to get the follow-up Q&A plus the trading room. So there's going to be plenty of time for you to come in, ask questions, and learn what you are having a hard time or didn't understand or need more information on. Go through in the course then what are the best time frames to use, to capitalize with the butterfly condor, and what are the best, things to trade. What, stocks, ETFs, index, futures, we can do all those. How to profit from, how does it work that you do profit from that volatility, collapse, time decay? How do you structure those setups that you get the 10 to 1 or higher? You saw some great examples here today that hopefully you show you what's possible. And then a really fun thing is how to trade these monthly option expiration type pinning trades that happen every month. So we've got next week is a monthly expiration. So we've been looking for a good pinning trade setups, and we've got one now on GLD. I'll show you here in a minute if we have time. So these pinning trades, we're going to go through in the course how to set these up, and when and why you would do it with the pinning trades for butterflies or condors using unusual option activity and Fibonacci. And then the other next part of the course, we get into the long condor, how that works, the long condor that gives you these returns of 100 to 200 up to 300, but with low capital at risk, also positive data. And then when would you use the long condor and why versus a butterfly? So that's a big part of the course, so you'll know when to use those. And then part 3 is just another great section. This is just a section that you don't want to miss. And this is what I call the progression of hedging. So it takes you through the various parts of the legs and things that you can do to hedge, okay, progressions. And then, then how then to use the butterfly and long condor to actually hedge maybe a core position you have on, which we'll go through. How to use the butterfly or long condor to defend vertical debit spreads or credit spreads. Okay, big thing there. How do you do a butterfly defense for a credit spread? You'll learn that in the course. Then I give you a step-by-step checklist when and how to use the butterfly long condor and when you take them off. If you do the alert service, I'm doing it all for you, but in the course, I'll teach you how you can do it on your own. And then I have a section in the course for somebody asks about assignment risk. So we go through execution, adjustment, management, but then we also, for the butterfly condor, but here's what I was pointing out, we have a part of the course, where I do go through and explain, exchange traded funds used, and then assignment risk, expiration risk, auto exercise, and assignment risk. Plus, I give you a trading library, so you can go back and look at other trades we've done to kind of understand them more. It gives you a place to go back and learn from, trades that you're looking at there. So there's it covers a lot in the course you'll have everything covered that you need to know. And then it's just a matter, like anything else, just going back and reviewing and coming in and asking questions. So this is a really great part that you're going to get if you do option 2. I highly recommend this. This is what I call my price target mapping course. And this is based not only on just Fibonacci, this is based on a combination of things that I look at, 5 different things I look at to set support, resistance ranges for targets or for defense targets for adjustments and stop loss. So it's based on a combination of using Fibonacci, moving averages, price action support resistance that I'll teach what that is, standard deviation for using your theoretical standard deviation forecast for price up or down within expected range move for certain time frames. That's part of it, and then any unusual option activity. So this course is a combination of 5 different things I'll look at, not just one. Okay, so it's a 3-hour course and with the training manual. Really great course. This is a freebie for you if you do option 2. It's just $30 more. And then you're going to also get for $30, for that extra $30 my start trading options today. It's kind of an option intermediate beginners course to get you started. Great one for your library, very comprehensive, easy to understand. I go through, the benefits of options versus stocks, tips that you need to know, must know option basics, the various things you really need to know about puts and calls, how option expiration works. And then I go through, and this course covers 3 different option strategies. The covered call strategy, the covered call with the protective put, the collar, and a vertical debit spread and resources. So you'll get that all, just part of the add-on. If you do option 2, you'll get that. And then you're going to get my Power Cycle Trading Club. If you do option 2, you'll get this for the next 60 days. If you do go with option 1, you're still going to get this for the next 30 days. So with this, you get access to my trading room from 9:30 to 10:30, Wednesday through Friday. The reason I used to do it every Monday through Friday, but I stopped about a month ago and started, just going in on Wednesday, because a lot of times Mondays are just kind of churn back and forth. The markets are trying to kind of feel its way out. And so a lot of times nothing really ever gets done. And then what I do, I start the week out with my weekly live Q&A, and that'll usually always be on Tuesday. So we kind of start Tuesday, and then Wednesday through Friday, the live trading room. Okay, so then I do my video updates every night that you can see what I'm thinking about the market. Trader video. We've got a lot of good trading educational stuff in your members vault, 50% discounts. This one thing I always like to point out, Jay said, reading books is fine, but seeing the actual option trade setups make a huge difference. So that's one really thing I like to point out there. You'll get that. And then everybody gets here. We'll do a live follow-up Q&A, which will be live and recorded. This will be the day after the course on Tuesday. But remember, you have access to the virtual trading room as well to give you more time. Everybody will get my option trading tutorial. So this is a 60-page guide with videos, more covering the Greeks, delta, gamma, theta, what those are, how they work, option pricing, what I call the market maker secrets. You'll see that in the course, standard deviation forecasting, how to use delta and option for your option trade probabilities there. And then you'll get one additional thing. If you do 2, you'll get my 15 option strategy guide. This is a really nice detail of 15 different option strategies, the constructions, how they're done, and when you would use it, like a back ratio spread or long straddle or strangle, things like that. So those are covered there. So just an additional option for you in option 2. All right, so now let's go through a few of the alerts to show you what we've done recently to give you an idea what you're going to get there. And this is a couple members. I really like to point these out. This is Waleed, one of my members. He actually lives in Kuwait, and he was saying, Larry, I have to mention one thing. I'm subscribed to a lot of services who send out trades. Some are good, others are not that great. But one thing that I would like everybody to know on this webinar is when I get a trade alert from Larry, I do it blindly as time to show me is dead accurate with its recommendations. I appreciate that. And that's why, I'm sure my goal is to get 80%, but we're close to that. And then here's Dan. He said, you're very diligent, totally thorough with your analysis. That is the foundation, the success of the alerts. I paid for here's what I was talking about earlier, my subscription with the first 4 trades I took with you when I was just learning how to trade options. So please feel free to share this with other participants. And that kind of summarizes that, I was talking about. So again, here's everything there. I kind of went through that. We'll roll on to what you're going to get now. Again, when I send out alert, a lot of people just want the trades. They'll do their own thing, but I'll always give you a suggestion option trade that I would use to give you what's kind of the appropriate one for that situation. I'll give you the entry levels, profit targets, like I showed you in those alerts. I usually give 2 targets that I'm looking for, and this is based on that price target mapping that I use. What option series to use, stop loss levels and guidelines, trades list and archive that I'm giving these. I'm always updated through the day. If there's something I want you to know, I'll send you an alert on text. We'll give it to you by email if you want. Preferably, it's better by text because they go out within a second. I do a trade setup video review that day or evening after the close to show you why I did the information, why I did the trade. I do that video newsletter every day after the close. We have a live trading review and Q&As every week, live and recorded. Access to virtual trading room. You'll get that for the next 5 months. Okay, either if you do option 1 or 2 for the alert service, I'm going to give you that part for 5 months. Access to trading club or trading room for Wednesday through Friday, 9:30 to 10:30. Typically go longer. those discounts, traders educational law. Now we use a service, what is called Telegram. So it's a really fast, free service. And this is what it looks like when it comes out. It goes out to you within seconds. And this is the, the trade I was actually showing you earlier. So let's go through a few trades here. Here's one that we've done. This was on Amazon. This was a long call butterfly. It was traded at 229.70, and we set this up on the 5th and took it off just a few days later on the 28th. Now it's trading up at 233. So this was sent out, to the members through the Telegram. It says Amazon, and this was what I call aggressive long. There are a couple of reasons I sent it out as an aggressive long, because typically I use a daily time frame, which is kind of the more swing trade. But this one I was looking at faster, maybe moving, the markets were really moving fast. So it's using a 4-hour time frame, so more aggressive type trade setup. So I just kind of wanted everybody to know it's maybe a little bit more risk to this type of trade, And it was trading on 229.70. Daily cycle low retracement reversal up to 200-day moving average, breaking above the daily 50 simple moving average, at the 4-hour positive momentum and upside momentum cross. I'm giving you the reasons for the trade. Target 1, 2, know your risk, taking the trade. Here it was, buy, butterfly, Amazon, 28 November, 230, 235, 240, call butterfly at around 125. So, you're not going to get it perfect probably, but anywhere around there, And that's kind of where it was sent out. Then on the 26th, send out an update, say, okay, if you're in the trade, and it's moving up and you have multiple contracts, take a little profit to lock in a trading edge. I call that hold balance. Okay, send out that little update. 28, Amazon butterfly. Now it's trading at 233.22 for all that held the trade long. Currently up around $197 per spread, 162% return. So that was the trade setup there. And here was the trade setup right here. It was breaking above that 50. See, I did this off the 4 hours. So quickly explain. So the momentum was just starting to come up on the daily, but I didn't have both sides positive, but I had it positive on the 4 hours. So aggressive trade here, but it worked out great. And so that was the trade, what it looked like when it was sent out on the charts. And then here was the trade, the diagram, the analytics on the diagram here is 230, 230, 235, $5 wide spread. Cost of the trade, 121 bucks. Potential profit is the difference. That'd be a 313% return on a close there. But, on these trades, we're happy with anything in between. We're still going to have a big return on what? Low capital at risk. That's the whole key. Low. If we do this, we have low capital at risk. We know that. All right. So here was just a balanced butterfly going out right about there. So it was up to 233.13. And, we didn't quite make our target, which was right here, but that's okay. That was the target there, but it came in a little short, but that's still okay because we had that wide butterfly. We're happy with that. We still ended up making, went from 121 to 318. We made 197 bucks per spread. Nice return in 3 days. Nothing to sneeze about there. Here's another example. Here's Amazon again on a long call Condor spread. All right, this is one that was done and it was traded here at 227.60. And, daily cycle low retracement reversal. Go through the reason, where it was, did a condor. So bought the 25 July 227.5, 230, and then had the 232.5, 235 part of it together. Sometimes usually we tend to do these all at once, sometimes maybe leg, but I don't typically send out legging because some members they don't know how to leg, and so they might make the spread better or they could make it worse. So usually I'll send it out just doing it as that condor. But if you're a good trader, if you're, have a feel for it, you can leg it, typically. So here it was on the 24th, did an adjustment. Here's where an adjustment came in. So here I say adjusting, buy to close at 25 July, 232.5, 235 call spread, sell to open. Now we're moving the call spread up right? Because it's moving up. So we rolled it up to the 235.5, 237.5. I sent that adjustment out. And now you've got the 227.5, 230 call short against it, the 235.37.5. We widened it out further, okay? Because it looked like it was going to move more. So we wanted it wider. And here it was the 25th, trade around 231.86 if long, you adjusted, et cetera, et cetera. Trade poised to go out at max profit on close today between 230, 235. It was up 143, 136% return. So here was when it was trade setup. Here it was grinding up here, and here's the the risk reward profile here. Max profit 145, max risk or loss 105. Debit cost here. Here was the spread initial setup right here, and so you can see 227, 235.5, et cetera. So 105 spread with 250. This was a narrower spread. So profit 145, 138. But again, think about it. So if you've got a really high volatility market, uncertain, you want to keep that risk down, but you want to make a profit. These are things that we'll go to try to play ranges or try to capture that potential profit, but with a lowered risk versus some other kind of strategy that you might use. Either long calls or long puts are going to be more expensive, have time decay, other things like that that are a disadvantage to the trade if things don't work out perfect for you. And things usually don't go perfect, do they? So here it was 105 to 248. So we had a profit 143, 136% return. And these are based, the analytics here, you'll see it based on one option contract, but that then convert, if you do 5, 10, 15, 20, you can kind of do the math and see where it could lead you. Now these are counter diagonals. We do a lot of these because these have been really great in the uptrending market that was just kind of smooth going, not a lot of volatility. These have been really good. And this is the part of it. If you do this alert service, this is what you'll get access to. Started this back in 2019, and through yesterday, we've had 400 of these trades closed out, 283 of them winners, 29 break even, 88 losers, 78% win rate here. Now the butterfly, we had a win break even rate of 80. So, those are very low risk, really high return potential trades. Very selective, the ones that I sent out, because there has to be the right condition. And so here was that Apple one that I showed you earlier. We'll just jump through this. This was the one that we originally set up as a calendar diagonal. And then we converted this, hedge trading, opportunistic management. We ended up adjusting this to that long call Condor. So I won't spend too much time. Went out here. This was up 1,225% return. So this is one we just closed out. Here's one that we recently did, this one on Chevron. This was a fantastic one as well. Set this one up on the 8th. It was trading 157.25. Did a couple adjustments here. The 23rd adjusted this also to the long call Condor, okay? So we do a lot of these adjusting to condors and butterflies. So primarily, when we do stuff like this, we tend to always look to adjust. So I won't take too much time, but here was trading 157 through the calendar diagonal, $250 originally. Then we did an adjustment here. It was up $226 per spread. Came over here, we did this adjustment. I said if long, the adjusted 160, 165 calendar diagonal. We're going to adjust this. We're adjusting this to the condors. So buy to close, 16 Jan 165 call, sell to open the 23 Jan 167.5 call, sell to open the 23 Jan 172 180. So what we ended up doing here was adjusted the trade to a long condor. So now we're in this after adjustment. We're long the 23 Jan 160, 167 a call spread, and then short against it, the 172 180. So we adjusted this from a calendar to calendar diagonal. And then on the 23rd, trade 167.65. Spread is up $700. On this one, we adjusted to zero risk. That's what we're going to show you in the course. So these are just, that's what we you play chess, 1, 2, 3 steps ahead. So beautiful setup, got in here, started trending. We adjusted it to the Condor, got out here, and we adjusted this to a zero risk trade when we did that final adjustment. So initially we started out with this calendar diagonal, that 23 Jan 157.5, 165. We were up here, profit of 226 just off this, 92% return. But the part that was so much fun is we adjusted this to the call Condor into, based on the adjustments we did, taking profits, et cetera, we had this into zero risk. So now we had adjusted this into that 23 Jan series, the 160, 167 called debit spread. And we had taken profit on the earlier debit spread side. That's what gave us the big profit. And then we sold against it, the 172.5, 180 call spread there. So we had this Condor on, and the cost ended up zero risk. Actually, we had a credit of $2. All right, so we had a credit of $2 actually for the spread. So $7.50 wide on each side. So $750 if it goes out here, potential profit plus that $2 credit. That's an infinite return, really, if you do the math, right? And so it went out right here. So here was that trade. So right here, adjusted call Condor, 167.80. So it went to, from $2 credit that we adjusted to 231 debit, 733% return. Not too bad there. So that was that. Here was another one. This one I'll just take. I meant to take this out. This was a good one, but I just kind of want to flip through these. I will go through this really fast. This is one that we did another one on ON, and this one turned out, I mean, this is a beautiful, look at this chart. That's a beautiful trade setup right here. Look at this. So it's just going sideways, right? We had a cycle reversal, so we knew there was starting to potentially bottom, but you don't know when to get in. But our momentum indicators went positive, cycle 1 and 2, so that gives us potential direction and a price trigger break here. So that's what you're going to get if you do the alerts. These are the same things that I look for, and that's why we get the high probability, because these patterns and stuff that I look at, I've seen them so many times. And then this one, just beautiful trend. Look at that trend up. I mean, it was just unbelievable. So we did this as a long call counter diagonal as well to start. This was Walmart. Sorry, this is this is weird. This is sorry. Yeah, this one. That should have been here. This was on Walmart. This was an unbelievable trade. We started this one out as a call counter diagonal on Walmart on the 25th. It's trading 105.50, and then we adjusted this into a long call Condor, and on the 5th into that long call counter diagonal, we adjusted this into the long call Condor. All right, look at that beautiful trend up. And then we did some adjustments here. So here it was just on the strict calendar, okay, calendar diagonal, long at 107, 12 December, short against it, the 5 December 112, 174 bucks. That's all, laid out for you in the text. And so then we had a profit take here on the 28th. Now it's trading at 110.51. So this was up $183 per spread. So, blew to 357. Spread cost there, we were up 105%, but we're going to make it better if I can. I'm going to send this out to you. And so here was another adjustment into a long call debit spread. This one we did into a call debit spread, excuse me. And so you can see here, we then adjusted this. Now we had this in a call debit spread. We're long that 12 December 110 call, short that series 12 December 116, $6 wide. And we adjusted it to where we had a credit now of $22. No risk. We had a $22 credit. We had that $5 wide, $6 wide spread. And so the spread here, you can see went from 22 credit. Now it's trading at 484 plus that credit. We're up 506 bucks on zero risk. So that's the ultimate. If we can do that, that's what we're looking to do. And then here are a few fun ones. I showed you these earlier, so we'll just kind of flip through these. This Gilead, I showed you that one. That was that butterfly penning trade. That was really, really, fun. So that was really cool. That was a nice one. SPY, I showed you that one earlier. This was an unbelievable one. This is one that we did on Tesla. This one had almost a 2,000% return. So we did this one. We did this 197.5, 200, 202.5 for 12 cents. That's $12 was the cost of the trade. That's why it was so amazing. That's why it got that return, because our risk was 12 bucks. So I'll just kind of flip through this because I know we've been here for a long time. So here was the trade setup, targeting over here to this 200 bucks. And so set this up on the 8th, add this into the 16th expiration, nailed it to the penny, which is very, very rare. So we had this on the 197.5, 200, 200, 202.5, $2.50 wide spread, cost 12 bucks. So potential for $238. That'd be a 1,983% return. And this thing nailed it to the penny. Now we're scaling out. You don't leave everything on for the very end, but this is what it did at the very end, right to that perfect place. And that in the course, I'll teach you how to analyze where it could go. So it pinned at 200. So this went out up 238, 1,983% return on that alert butterfly that was sent out. This is a couple just to show you quickly earnings. This is another thing you'll get during the earnings season. These are very selective. Started this back in 2019. We've had 152 closed out, 112 winners, 17 break even, 23 losers, around 85% win rate on that. Very selective, unaudited. This is what you'll get if you want to take these. Some people don't like them. Some people love them. This is one we did not long ago on deck on the 29th. And this was out the next day. This is, one for what we call a breakout iron condor debit spread. So this is an iron condor type trade, specifically set up for an earnings trade, earnings release trade. So they, earnings are announced. Trades either a lot of times will break hard to the upside or downside, or volatility collapse. This is set up for a big breakout trade. And so we did this with the long iron condor. So basically just a call debit spread and a debit spread, two debit spreads here. Risk on this trade was set up for 145 bucks, debit cost risk. It was trading right here. So it hit, it's the way I analyzed this for big price spikes, and that's why we did it for this kind of arrangement, just to show you. But this is what you get if you want. And I've got an earnings course to teach you how this is done and why it's done and how to set these up. So that's really everything. If there are any additional questions, let me know. And yeah, here, Barbara's that link again. Make sure to take advantage of it. And I'll be looking forward to seeing you there at the course. Here it is. Oh, let me show you what we currently have on. We've got a Lotto Butterfly currently on for GLD. I'll show you that real quick. If you want to see it, let me show you real quick. So use that link there, and I'll pull up my chart. I'll show you GLD. In the course, I'll show you and teach you, how we set these up and why. There's a lot of number of things that go into these types of butterfly pinning trades, and they're very selective. It's not something we're always doing, right? We're typically doing it for a certain period of time we're looking at. So here's GLD, and we've got a butterfly set up for expiration next week, which is the monthly option expiration series. So here's what's the sent out. This was the alert trade sent out to the alert members I believe we sent this out last Monday. And so here's where we are. So we're looking for a target here up to, and we're close. We're looking up, but I'll go through in the course how we select the targets for the pin. So we have a target at 275. So we did the 271, 471, 75, 479, $4 wide spread. Our risk is 24 bucks, right? Potential profit is, if it goes out at that 471, then it's a $4 wide spread, so $400, right? less our cost of the trade, which at that is 24 bucks. Some members got it on for 20, you know, on your risk of 24. So if we were to get a pin, which we could easily here next week or any between, it's going to be huge. But if we got to move here, this would be a 1,566% return. All right, so sprinkle a few of those in there, and also tell your buddies you just made a 59% return in a week. So that's one that we've got currently set up on that. Oh yeah, and then if you want, here's the this is another alert trade that was sent out. I didn't show you this one. This is one that we just did Thursday. This was on QQQ. This was a momentum breakdown trade, doing a put debit spread. We set this up on the 12th right here. And, this is where we are. We had a number of different profit take areas on this, and options on this, but this was the trade setup. So we're currently I sent out an option to the alert members on Friday to either close out your trade when it was down here, because this is a big support area that around 600, or we took some profit, make sure you took 50% off. I said take 50% off at least, and then if you did want to hold it into Tuesday, which we have a holiday on Monday. So this was a spread setup along the 606 put short the 602 put 17 Feb. That's Tuesday series for we did this around 88 bucks or less, and so I have potential to make over 300 bucks on that risk. And if we wanted to, we could convert this to a put Condor. So that's a trade that we currently have on as well. All right. So again, thank you everybody for being here. That's what you're going to get. Any last question, I'll be happy to help you today. If not, that's what we're doing next weekend. And here's the link one last time: powercycletrading.com/ I got the wrong, hold on, sorry, / special. And you've got the two different packages, and go from there. Here we go, right here. Okay, use that link there. And then, last but not least, small cap, make sure it's small cap, Butterfly BF 15. All right. Did that go through? There we are. Okay, thank you, Barbara, Joanne, and I'll see everybody next week. Thanks again, everybody. Have a great rest of your day, and have a nice long weekend, and I'll see a bunch of you next week. Ciao.